So hello, good morning to everyone. So let's start the second day of this workshop. Will be a long morning. So now we'll have session 4, bank runs, contagion and systemic risk. And we have the pleasure to have Tirupan Goel from Bank for International Settlements with a paper efficient or systemic banks, can regulation strike a deal? Tirupan, many thanks for your availability. The floor is yours.
Thank you, Samuel, and thanks to EBA for including this paper. So I'll start with sharing my screen. So I hope everybody can see my screen.
Perfectly.
Very good. So yes, this paper is concerned with the organization of the banking sector. And the usual disclaimer applies. These are my views and not those of the BIS. So if we look at the US banking sector, for example, there were a large number of banks up until the 1980s. Then the Branching Deregulation Act led to a wave of consolidation and fewer and bigger banks. But then in 2008, the great financial crisis underscored the too big to fail issue, which led to reforms that create disincentives for banks to become large, and notably the GSIB framework. So this raises a question for the policymakers. Should they favor few big banks or many small banks? The underlying question is that of an efficiency versus financial stability trade-off. So on the one hand, large bank failures are socially more costly. And there is a large literature that talks about the reasons for this. There are resolution-related fire sales, systemic losses, complexity, and by some estimates, the GFC wiped out around 4% of global GDP. But on the other hand, larger banks tend to be more efficient. And there are many reasons for this, both theoretical in terms of diversification of risk, spreading of fixed cost, operational synergies, but also supported in empirical studies such as Hughes and Mester, who show that even after taking account of risk-taking incentives by the larger banks, there are scale economies even for the larger US banks. Sorry, I think somebody is not muted. So yeah, so in a nutshell, what I'm focusing on in this paper is this efficiency versus financial stability leg of the three-way trade-offs that is relevant for the question of how should a banking sector be organized. So to this end, what I do in this paper is to embed a heterogeneous banking sector in a macroeconomic model where there is endogenous entry and exit, and the size distribution of banks is also determined endogenously. I calibrate the model using microdata on US banks, and the analysis has two parts. One is the positive analysis, where I assess how capital regulation shapes the dynamics of the banking sector, and then the normative analysis, where I characterize the optimal regulation. So just to give you a preview of the findings, tighter regulation has opposing effects on the bank size distribution. On the one hand, lower leverage, it makes banks grow more slowly. But on the other hand, because now the banks are safer, they survive longer. So these two opposing factors then determine what the response in the size distribution should be. And I call this the bank dynamics channel of capital regulation. Turning to the normative analysis, I show that equating either the leverage or the risk-weighted capital requirement or the expected loss across banks is not a suboptimal policy. To optimally balance the financial stability versus efficiency trade-off, regulation should be flexibly size dependent. So in other words, a size dependent trade-off requires a flexibly size dependent policy. And the calibrated model shows that the optimal regulation should be tighter for larger banks and more liberal for the smallest banks. And as a result, it leads to more middle-sized banks. So with that, let me get into the paper very quickly on the related literature. The paper touches on 3 strands of the literature. One is the banking IO, bank heterogeneity papers, and this is an upcoming field within the macrofinance literature. And obviously, the paper speaks to the capital regulation literature. So the model, it's a discrete time model. The horizon is infinite. There is no aggregate uncertainty, but there are bank level dynamics. The entities are households, which are pretty standard. I will not go into that, given that I have only 12 minutes. There are banks, which are heterogeneous. There is a government that runs deposit insurance and a regulator that sets the capital requirement. So the bankers, which are atomistic, there is a unit mass of them. They choose the various balance sheet components, namely the assets, deposits, and the dividends, to maximize the stream of dividend payments, which is given by E. And this is the continuation value, which depends on the evolution of the net worth, where N is the net worth. So basically, the net worth evolves as a result of assets providing certain returns, stochastic returns, and net of the payout on the liabilities. Banks whose net worth N prime falls below a certain cutoff, they exit the industry, and they have to and each bank has to satisfy a cash flow constraint, which is pretty standard, and a regulatory constraint. So, basically within the period, banks wake up with a given net worth. The bank-specific asset shocks are realized. Some banks fail. New banks enter the industry, and then whoever remains pays out the dividends and chooses the balance sheet for the next period. Turning to the calibration, I'll comment on 2 key aspects. One is the estimation of how the cost of failure relates to bank size. So here, I assume that for smaller banks, this is more or less, this cost is calibrated on the basis of the cost incurred by the FDIC in the US for banks that are resolved. For larger banks, there is a systemic risk component, and I consider 2 scenarios, a baseline scenario given by the orange line and the severe scenario given by the blue line here. And this results in a convex total systemic cost of failure profile here. I also estimate what the return on assets as a function of the size of the bank looks like. And this is an increasing and concave relationship. And similarly, the riskiness of assets for larger banks is lower. So the bottom 2 panels use the call report data for US banks. A key feature of the model is to match the distribution observed in the data. So as you can see here, the model implied distribution of bank capital matches quite closely with that observed in the data. In particular, the right tail, which I estimate using a power law. This is important because I'm trying to get at what the distribution of banks should be. So getting the distribution model implied distribution right is an important element of the exercise. So now turning to the positive analysis, tighter regulation leads to lower bank lending. As you can see, going from the blue line to the red line to the yellow line, regulation tightens, banks are able to lend less. That's pretty obvious. They also pay less dividends because now they need to preserve the capital, but at the same time, their PDs are lower, banks are safer. So this is the standard output versus financial stability trade-off that other bank capital regulation papers have. What this paper adds is this industry dynamics trade-off, which is that lower rate of growth in bank size combined with the higher probability of survival leads to more middle-sized banks. So as you can see, the red area is where the mass of banks is lower, and the green area is where there are more banks in the steady state equilibrium. So what this results, what this means for the normative analysis is this inverted U-shaped welfare function in the last panel, where the red dot indicates the benchmark and the black dot indicates the benchmark and the red is the optimal. So what this is a result of are several forces going in opposite directions. So let me highlight a couple of them. So in the second panel on the top row, you can see that aggregate capital increases. And this is because of the capital preservation that banks engage in. But at the same time, overall lending declines. Average PDs decline, and so does the average, the total bankruptcy loss incurred by the economy. And this is what underpins this hump-shaped welfare profile. Now, in this regime, I assume that the regulation is the same for all banks. In the next experiment, counterfactual experiment, I consider a risk-sensitive capital requirement, which varies across banks. So it basically, I equate the probability of default across banks. And as you can see here, this entails that regulation should be tighter or higher for the smaller banks because the smaller banks are riskier. This regulatory regime also leads to an inverted U-shaped welfare profile, but the maximum welfare achieved in this case is lower than the previous regime. The next regime is one where I equate the expected loss, which is a product of PD times exposure at default times the loss given default across banks. And this regime entails that the larger banks, which have a higher EAD and higher LGD despite having a smaller PD, they face a greater capital requirement. And because this regime takes further into account the riskiness of the banks, the welfare in this regime is higher than the previous two regimes. So so in this case, the regulator is going further in terms of managing the overall systemic footprint of the banking sector. But what I'm showing next is that even this regime is not the best because it fails to take both efficiency and the financial stability aspects into account. So to this end, I consider a flexible size-dependent regulation, which varies by size. And here, the highest welfare is greater than all the previous regimes. And this regime basically gives a regulatory subsidy to the smallest banks and a regulatory penalty to the largest banks. This is indicated by the red line here, which is underpinned by this hump-shaped welfare profile for small and large banks. So to summarize, what I ask in this paper is whether regulation should encourage or discourage large banks. the trade-off I'm looking at is efficiency versus my financial stability. Develop a tractable model to study this trade-off. It features heterogeneous banks and endogenous size distribution that give rise to a bank dynamics channel. The main takeaways are that regulation has opposing effects on the bank size distribution. Size-dependent regulation is needed to deal with this trade-off, and the optimal regulation is tighter for larger banks and induces more middle-sized banks. Thank you for your listening, and let me stop sharing.
Many thanks, Tirupan. Now, as discussant, we have Jonathan Acosta-Smith from University of London. Jonathan, can you try in 6 minutes to compensate? Yes, thanks.
I'll try my best for 6 minutes. Let me see if this works. I'll get to it. So yeah, as Samuel just said, I'm. Does this move? Yes, it does. Jonathan Acosta-Smith. I will be very brief. So I'll just quickly run through what my key takeaways from the paper were, but I'll be very, very fast given we just heard it. And then I will run through the comments that I have on the paper. So what are the key aims of this paper? So this is what I got out of reading through the paper. 2 key questions. First, should the banking sector be organized as a few large banks, or should it be several small banks? We can look across the world. Different countries have different structures. Germany has many smaller banks. UK has very large, a few banks. So what's optimal? And then alongside that, what should we do as regulators? How should we optimally adjust the capital requirement? And does that have an impact on size? So these are simple questions, but they're very complicated. So particularly in the model that is developed, the answer is so much more complicated by the fact there's an inherent trade-off between this financial stability on the one hand, which is kind of, and I'll come to this in my comments, it's built into the assumptions that larger banks have bigger systemic risks, which I can buy, versus an efficiency trade-off. So there's also an assumption in the model that larger banks are just more efficient. And how is this come about? It's through scale economies. So as we just heard, then this is embedded into a macro model, and we can determine optimality. So what are the key results? Sorry, this is a bit slow. Here we go. So the key results are that we're essentially kind of doing this wrong at the moment. So a capital requirement that is the same for all banks, so think of a leverage ratio, doesn't give you the optimal. A perfectly risk-sensitive requirement, think of a risk-based capital requirement, also doesn't give you an optimal. And equalizing EL also doesn't give you an optimal. So what does? Well, optimal regulation is size dependent. So think of this paper kind of motivates and gives evidence towards the development of the GSIB buffer. So this paper shows that stricter rules for larger banks can enhance financial resilience, and an optimal regulation should be a balance between this efficiency and financial stability trade-off, and you can achieve that through size-dependent policies. So hopefully that was essentially what you just heard in the previous few minutes. Now to my comments. So it's really a great paper. So let's get that out there first. It's a very important question, as you all know, and it is very well written, the paper, if a bit long. It's like 70 pages, so this is every referee's dream. Anyway, so but it's nicely written, so it does flow through quite quickly. As I said, and we saw that in the main results, there's some clear policy angles here, and it feeds directly into the Basel discussions. And that wasn't easy. And if you read through the paper, you'll notice that this is not easy. The statement that the result is not obvious comes up a lot. So there's many different interactions that go in opposite directions. And so it's been a quite challenging job, I can imagine, to write this in a coherent way. A number of robustness checks have also already been done, which kind of made my job more difficult because I couldn't tell him to do things. But there's still some things that I would like to comment on. So I guess my first point was that there was some slight confusion for me on the actual aim of the paper. So this is kind of in some ways somewhat more of a minor point, but like, so first half of the paper starts to talk about the optimal number of banks, and should we have many small banks, should we have many large banks, what's the optimal distribution? And that kind of just drops out halfway through the paper as we move on to the optimal capital regulation. And then the paper starts to emphasize the size-dependent capital regulation point. And both are really valid points, but I felt like there was kind of a disjoint between both parts of the paper. And they're really heavily interlinked, these questions. But what was the main aim of the paper kind of then got a bit confusing. So that's one point that I wanted to make. The second point I wanted to make is this key assumption that drives the results. So the whole thing is about this financial stability efficiency trade-off, and that's really driven by the assumption on the more costly default from the larger banks. So from the systemic risk that's incurred from that. Now, I buy this completely. However, it would have been nice to do a little bit more sensitivity around this, particularly given all the discussions on orderly resolution, on the introduction of MREL, etc., etc. How would this change the results in the paper? Because if we can reduce the extent to which this default is costly, does this change the degree to which the capital ratio that is defined as optimal in the paper changes? So if I remember correctly, the paper comes with a number of 5.2%. And this is obviously dependent on the calibration and everything. So if we change these assumptions, does this push this down or up? I missed that discussion from the paper and that extension. Then another point was the paper kind of, to my mind, somewhat omits a question of moral hazard. So there's an assumption in the paper that larger banks have an inherently more favorable risk return profile. And as in standard in this literature, deposit insurance is mispriced. So we have this put option function for banking. However, there's no ability for the banks to risk shift in the model. So if there was an ability to risk shift in the model, what would occur? Would we get larger banks risk shifting by more, given they have, say, implicit government guarantees, given that they think they're too big to fail, given the systemic risk assumption that's already baked into the model? Again, I missed that from the discussion, and I missed that from the paper. So then my last few comments are more in terms of how we can map this more into policy. So as you heard from the presentation, the paper tries to develop what is the optimal capital requirement. And it really touches a lot on this minima versus buffers discussion. What should the minima be? What should the buffers be? But it is chiefly concerned about the minima. So my question was, given some of the results, could we push this a little bit further to help us in this debate? So the obvious area in which the paper already alludes to is on the justification behind the GSIP buffer, and that naturally feeds out of this size-dependent regulation result that's in the paper. But it's really very minimal. And I wonder whether you could maybe push this a little bit further to get us greater insights on the split between minimum buffers, as particularly given that your key result is based on size, but also in terms of my next point, which is on considering potentially the impact of cyclicality. As we all know, cyclicality will adjust what is optimal across the business cycle. And this is somewhat completely, well, not somewhat, it's completely ignored in the paper. I do bear in mind, however, that this is already an extremely complex model, and there will be limits to the extent to which you want to complicate this. So let me finish, and I think hopefully I've done my 6 minutes or haven't gone over. My last point, which is there's a lot to say here on smaller banks. And if you do read the paper, the degree to which it's optimal to have a number of smaller banks versus medium banks and larger banks just feeds out of the model, but then it stops. I kind of lacked the intuition, or missed the intuition in the paper that fed me into thinking, okay, why and what, and is this a good thing in a policy and a real world perspective? It's obvious within the model because it's just this trade-off between two elements. But can we say more, particularly given our interest in a separate regime for smaller banks? So there's one extension of his model where you get very, very low capital requirements for small banks, and that becomes the optimal. But that's a tiny extension of the paper, which maybe you could delve a little bit more in detail on. So thank you very much. It's really a great paper. These are very not major comments. So I wish you good luck with the revisions and with all the future efforts on the paper. Thank you very much.
Many thanks, Jonathan. Tirupan, do you want to start, and then we'll try to find more questions from the audience and participants?
Sure, Samuel. And thank you, Jonathan, for that very detailed review of the paper and your constructive feedback. So let me be selective. So one of your points was the two questions about optimal number of banks and the optimal capital regulation. I kind of agree with you that the answer that I provide is more on the second question, less on the first, and that is kind of because the first best, which is the planner's solution, is a more difficult one to tackle, and also less policy relevant because, after all, policymakers can have this tool, which is the capital regulation, and that is what they can use to influence the distribution of banks. So for them, the optimal distribution of banks is what they can achieve with the tool that they have. But I agree with you that I can make this clearer upfront, what is the main goal of the paper. Your second very good comment was on the role of orderly resolution and how that can affect the results. So an orderly resolution would certainly reduce the cost of bank failures. And I try to take the stance in the paper that this is not a paper that tries to answer the question as to how big the systemic costs of bank failures are. Rather, take a calibrated input into the model and then do comparative statics with respect to that. So one of my extensions actually varies the cost of bank failures and traces how the optimal regulation changes. So hopefully that goes a little bit into the direction you are pointing to. But it is true that even on the scale economies, the jury is still out there, right? How large these scale economies in banking are, I don't want to take a stance on that. So the calibration that I do is kind of a baseline, and even with respect to that, I do comparative statics to trace how the implications for optimal regulation would change. Moral hazard. So larger banks know that they are more efficient and less risky. So they do take that into account when choosing their balance sheet. It is true, however, that because the capital regulation is binding, there is very little in the model to allow them to risk shift. So that is true. And this also relates to your point about minimas versus buffers. So capital regulation is always binding. I don't allow for a management buffer over the minimum capital requirement. But that, as you also acknowledged, would make the paper more complicated. Let me stop here to see if there are any questions from the floor. Thanks again once, Jonathan.
Many thanks, Ruben. I don't think that we have one question. Can you be very short? And we have the micro there. Very short.
Thanks a lot. I have two very quick points. First one, when you consider assets and when you consider capital regulation on the riskiness of assets, we always do it with accounting rules, which is a problem when we get close to crisis, because then investors look mark to market. So how would it change at least intuitively, how would it change the results? Second, size regulation is problematic because it becomes endogenous on the decision of banks. And the 2023 crisis is a very clear example. If I set size regulation to 250 billion in the balance sheet, then I will have a cluster of banks that are just below, just to exploit this. So how do you square this circle? Because if it is all exogenous, it's fantastic, and you can clearly say it where's the optimal size, but then bank endogenously adjust.
Sure. Thanks for those two questions. So quickly on the second one, you're right. Even in the GC framework, because we have this staircase structure, there can be bunching around the thresholds. And that is precisely why in the paper I work with a more continuous regime that minimizes the incentives of bunching around any specific threshold. So it's a more continuous size-dependent regime. On accounting rules and mark to market. So in my stylized model, I don't make a distinction between the two. So I mean, each period there is a stochastic shock on the assets, and that is immediately reflected in the risk-weighted capital requirements. So yeah, the accounting versus the market based is the same in my model. Thank you.
Many thanks, Ruben. So let's move to the second paper, investor attention to bank risk during the spring 2023 bank run. We have one of the authors, Hassani Sarkar, from the Federal Reserve Bank of New York. So Hassani, the floor is yours.
Thank you very much. Can you hear me?
Yes, very well.
Okay, great. So I'm going to share right now. Okay, so I hope you can see my slides. So usual disclaimer: the views are stated are those of the authors, and they do not reflect the views of the Federal Reserve Bank of New York or the Federal Reserve System. And this is co-authored with Natalia Fischel-Lanzoni, who's at NYU, Martin Heaty, who's my colleague at FRBNY, and who's also on the call, and Nathan Kaplan, who's at Harvard Business School. So what is this paper about? During the March 2023 bank run, the speed of deposit withdrawals was very, very quick, which was viewed as was called the idea of the sleepy depositors, the idea that depositors were not monitoring or disciplining bank managers leading up to the crisis. But in the literature, there's this idea that other stakeholders could potentially discipline banks. For example, bond market investors, potentially, in the modern era, Twitter users, or very large depositors. So the question we're asking in this paper is that whether stock market investors can discipline banks. So to that end, what we do in this paper is we estimate stock market investors' perception of bank balance sheet risk at a high frequency. And we asked specifically the following questions. How do they update their beliefs about bank risk before the run and during the run? How do they update during the run, especially when new information about bank risk is revealed? So do they, for example, update their beliefs using all relevant information, or given that so much information has come out and they have limited attention capacity, do they focus on only a small number of banks that are salient to them? So clearly, this question has practical relevance because both market participants and policymakers look to the price dynamics to understand what's going on and what actions to take. So I'm going to go over the methodology, talk about the informativeness of rating announcements, then the main analysis, which is the perceptions of bank risk, how do they change during the run, and then prior to the run, and going back to 2022, we go back to 2022. The reason is because a lot of these balance sheet risks were actually visible from regulatory data even back in 2022, and then conclude. Okay, so the main kind of analytical element in this paper is this estimate of a beta. So this is a beta which is related to the bank balance sheet risk. So balance sheet risk. So the way we estimate this beta is by using standard asset pricing methodology by creating factors. So if you look at the chart, the figure below, this kind of summarizes how we do it. So let's suppose the call report deadline for 2022 Q3 is October 30. So by that time, all investors, stock market investors, have this information, the balance sheet information. Then what we do is on October 31st, we form factor sorted portfolios. So for example, one factor could be uninsured deposits as a percentage of assets. So we would sort banks on this uninsured deposit ratio, and then we would project this into the space of stock returns. So we can form groups like high uninsured deposit ratio, low uninsured deposit ratio, calculate the stock returns, and then take the difference. So we have a long short portfolio, and that is our factor. Okay, and this is what we will track during the bank run, and the sort of the advantage of this is sort of the balance sheet data, of course, quarterly. By projecting into the stock return space, we can get a daily estimate. Okay. Now we will look at different cross-section of banks, and these cross-sections will be determined based on various information events, and these information events are related to rating announcements. So specifically, there were 2 rating announcements. So in March 14, which is just after the bank run started, 5 banks were put on downgrade watch by Moody's. And then between April 14 and 21, 12 additional banks were actually downgraded. So if you look at, I think, sorry, there's some background echo. So if you look at the, can we have,
Sorry, Asani. Yeah, I think you are muted now as well. So can you unmute?
Yeah.
Yes, sorry.
Okay now? Okay. So if you look at the table below, the top 3 banks are the failed banks. We exclude these banks from the analysis because they have so much volatility. And of course, they are out of the sample early. And then the main group are the March downgrade watch banks, the banks which were downgraded in April, then the regional banks that were not downgraded, which is shaded in green. And finally, a control sample are going to be the non-downgraded stress-tested banks. Okay, so the first thing that we do is ask whether the ratings themselves were informative. So this is important because if the ratings are informative, then that means that they're providing information which the stock market investor did not have. So presumably they would take that into account. But if they're not informative, it's already incorporated into stock prices, so it should not be relevant. So what we find that the ratings are not informative. And then if you look at the chart here, these are abnormal returns of various bank groups. And if you look, for example, at the March 14 dotted vertical line here, you can see that the abnormal returns actually don't decrease. In fact, they're either flat or they increase. And similarly, the case for the other ratings. So in fact, there were no decrease, abnormal announcement effect on the abnormal returns, implying that the ratings themselves did not have an effect on the stock prices. Okay. So given that, now we go on to do our estimate our beta. And this kind of figure kind of summarizes all of our results. So the first, I'm showing you essentially like one of the factors, which is this uninsured deposit as a ratio of, as a share of assets. And then we have three other factors, which is these unrealized losses on securities as a share of assets, this cash as a share of assets, and the CET1 ratio. Okay, so for this particular factor, the green is the estimate prior to the run, January and February of 2023, and you can see the factor is essentially estimated as 0. Then we go to the bank run sample, and now the factor becomes, the beta on the factor becomes positive and significant. So in other words, now the stock market investors, before the run, they were not considering uninsured deposit as a risk factor, and now they are, in fact, actually considering this as a risk factor. The beta is positive and significantly different from 0. Now, the interesting result comes when we look at the first month of the sample, the post-run sample, which includes this rating announcement in March. So here now we have three groups. The control group are the large stress-tested banks, and this is the group that were downgraded or put on downgrade watch in March, and we can see that this beta is positive and highly significant. Interestingly, the beta of the other regionals, which have similar balance sheet characteristics as the ones which were put on downgrade watch, that remains at 0. And of course, the large stress-tested banks beta also remains at 0. We get a similar result for the April events, downgrade events. Basically, only the banks that were on for which the ratings were downgraded, only their betas actually go up. No other banks' beta go up. So in other words, what we are seeing is that the investors are not necessarily updating their belief about bank risks for all relevant banks. They are pretty much confined, or they're relegating their attention to the banks which were in the ratings announcements. Okay,
Hasani,
and this is just a
can
robustness check.
2 minutes, 3 minutes?
2 minutes?
Maximum?
Okay, sure.
Thanks.
I'm going to have, okay, so this is essentially my final slide. So how can we explain this result? So we have two potential hypotheses. So one hypothesis is that investors have limited attention capacity, and so they coordinate their behavior based on their rating announcement in order to update the beliefs. The other hypothesis is that the stock market investors have an accurate prediction model, and they focus on the same set of banks as the rating agency, which is consistent with the ratings being uninformative. So we test this in the following way. We estimate the change in the beta with respect to January and February for 10 days pre and post announcement. So if the first hypothesis is true, that the ratings act as a coordinating device, then the betas of only the event banks, the banks that the ratings change, those betas should only change, and they should only change on and after the announcement. It should not change before the announcement, right? Because the announcements are coordinating the updating of beliefs. The second hypothesis would imply that the betas would change for not only event banks, but potentially other risky banks, and could potentially change before the announcement. Okay, so this is the result for two factors, the uninsured deposit and losses. So the main result is that the betas actually change in this period, the 10-day period between March 1 and 13. This is prior to the rating announcement on March 14. And you can see this is this shaded in red. So a number of groups, a number of banks, not only just event banks, their ratings change. Okay, so This is consistent with the investors having a prediction model and not the hypothesis that the ratings are coordination devices. However, the ratings are not, the prediction model is not very good. It's very noisy because you can also see that the stress tested banks, the very large banks, which did not suffer during the bank run, their betas also went up. So the investors are not doing a really good job of discriminating between which banks are risky and which banks are not. So that's I will just end there. So we also do an analysis of 2022 and have a similar result that the investors' perception of risk was kind of temporary and was limited to a small set of banks. And in future work, we are going to look at additional measures of information arrival and try to estimate more precisely the investor's prediction model. Thank you very much.
Many thanks, Hassani Sarkar. Now we have Carmelo Saleo from the European Central Bank. Can you try it in 6 minutes, Carmelo, the discussion? The floor is yours. You see Carmelo there, but let's see. Okay, so when we can open also the questions from the audience, if we have any already. Okay, so let's start with the Klaus from the ECB as well.
Yeah, thanks a lot for this very, very interesting paper. I have one question. I wonder, why are you looking so much as abnormal returns? Wouldn't it be more natural to look at basically withdrawals of the customers in order to assess which are the banks to which they react or not? Thank you.
I think we have another question from the audience.
Cedric from KU Leuven. So I was wondering if you argue that the investors have this kind of like prediction model that they then use, and that's why the betas change. Can you test whether this effect is stronger for banks with informed investors, like institutional investors, let's say, if you know something about the investor base of the banks?
Okay, any other question? No questions also from the virtual participants. So maybe, okay, so Hassani, can you start answering? We'll see that if Carmelo can enter after. Thanks.
Sure. So yeah, I think I start from the second question. So I think that's a good point, and that's something which is we have not done that as yet, but that's on our agenda to see whether the investor base it makes a difference whether you have a more informed investor base or not. The first question, I guess the question was why we're using abnormal stock returns rather than something else. So the main reason is that we wanted to get something, a measure which is available at relatively high frequency, and it would be available for our full set of banks. So that was the main reason for using abnormal returns, and then we also wanted to get to this beta. Essentially, we're not really looking at the return themselves, but we are estimating the covariance between the returns and the returns on the balance sheet factors. So this balance sheet beta. So to do that, we do need the excess return of the abnormal returns.
Okay, many thanks. Also, Hassani Sarkar. So let's move to the third paper, Contagion from Market Price Impact, a Price at Risk Perspective. With us today, we have Matthias Zido, also from the European Central Bank, as one of the authors. Many thanks. And let's try in 10 minutes, 11.
Okay. Good morning, everybody. So this is joint work with colleagues from the European Central Bank and the DNB Gabor Fuka, Michael Kaiser, and Luca Mingarelli. And it's a spin-off paper actually from a larger stream of work that we have been conducting at the ECB over the last 6 years to develop a system-wide stress test model. And the spin-off nature of this paper is that we try basically here to get an understanding what is happening if financial institutions in the system, they leverage and sell a larger amount of assets in terms of price impact, and how can that lead to contagion. And see, the usual disclaimer applies. So these are the views of the ECB and not the views of the ECB or the Euro system. And let me jump right into the subject matter. So in the interest of time, I skipped the introduction, what we are doing, but here I give like basically the core of the analysis in terms of the methodological specification. So what we do is basically we estimate a quantile regression. And that quantile regression is based on two streams of literature. One stream is about price impact parameters. So this is the most famous thing is Kyle's lambda, which basically makes a relationship between volumes traded and the change in price. This is a linear relationship. Then there's further models that expand on this, square root model, and ultimately the exponential model. This is also, like, say, the most commonly used model because it has the advantage that the price impact converges to a certain boundary and doesn't overshoot, and it works quite well in the framework that we are looking at, because you can look at price impact from the really very granular perspective of limit order books or meta orders, or you do it in a more aggregate fashion, and that is what we are doing here. So we look at price impact of ISIN level securities. That's how our estimation framework works. And we have a quantile regression framework that is based on the work done by Simone Manganelli et al. And Brunnermeier and Tobias Adrian on COVAR. So these two streams of literature are combined here. Now let me explain how this works. So on the left-hand side in this equation, you see here the return R, which is dependent on the volume traded, and Q is the quantile. Then we have two regressors. The first one captures the exponential function, and in there you have the volume traded, and the second regressor is the market return, so the system level component that is supposed to capture basically what's happening in the corresponding market segment where this ISIN is located. That's the concept. And with this, we can isolate the effect that of price change for an individual security. So now with this, I introduce you now to the rest of the work that we are conducting. So here's an overview of the data we are using. So we gathered all data that we have available inside the ECB on equities and bonds. And in total for equities, we cover 7 trillion euros, and for bonds 7.9 trillion euros. And we bucket this into different market capitalization buckets, so 1 billion, 10 billion, 100 billion, and we do this also in terms of residual maturities. I'll show you this later on when I show the results for FCs, NFCs, and governments on the bond market side, and for equities, we just distinguish between financial corporations and NFCs. And now practically, so you saw the equation that I showed before. What does this mean in practice? And I try to visualize this here with these two graphs. On the left-hand side, you see for an individual ISIN, a scatter plot that shows on the x-axis the volume traded in terms of millions of shares, and then on the left-hand side the change in price. And the blue dots basically show the negative price changes, and the green dots the positive ones. And as you can see, this is scattered across the whole board. There are a few outliers. The question, though, is how can you infer from something like that a price impact? And what we do is basically with the quantile regression, we basically, and that's what you see on the right-hand side, we basically fit a line through this cloud, and this is now focusing only on the negative price impacts for different quantiles. And these quantiles allow us to capture the tail impact, because the literature itself is focusing normally on the average price impact. And what we do here is with this combination of using an exponential function that allows us to have not an overshooting in terms of the reaction when you go to larger volumes being traded, to have here still a meaningful result, but with different levels of severity that can be also matched to the scenario probabilities that we introduce for stress testing. Now, how does this look like in terms of the results? So there are two charts now that I'm showing you, so slides, this one and the next one on the equity prices. It's a lot of information in the interest of time. The key takeaways are the following. Bonds react very mildly, equities very strongly. And there is a certain segment in the equity market, which is the small and medium-sized entities. They can react up to 40%. So if you are an investor and you hold a portfolio that includes equities only for SMEs, you have the potential to have a very strong price impact on your portfolio. Therefore, it makes sense to diversify and also have bonds. And now let me move into the bonds. So this slide is built up in such a way that the horizontal rows basically show the price impact for different volumes traded. So the first row is related to volume traded of 10 million, and the second row shows volume traded of 100 million. And then the three columns refer to different residual maturities, so 2 years, 5 years, and 10 years. And what you can see that, so governments, which is the yellow line, they have the smallest impact, and across the board, there is a differentiation between the maturities. So if you go to the 10-year maturity, you have stronger price impacts than in the 2-year maturity spectrum. And you see also that it depends where you are in terms of the volumes traded, that it's not the same. Why is this useful? Think about all kinds of different applications. One important one is, for instance, even in the monetary policy context, there is a large literature that looks at what are changes in government bond yields. With this type of work, we are also supporting this analysis because you can see if the change in the purchases is of number X changing, what would be the potential price impact with this very reduced form approach. Now moving to the more strongly affected market, which is the equity segment. And here we just have this distinction between FCs, so financial corporations, and NFCs. Here you can see basically that on the y-axis, where you see the price change, the bottom left has the minus 40%, and this is what I was referring to. So this is the most strongly affected segment of the market. Other segments have smaller impacts, in particular, if you look at the very large caps, so 100 billion market capitalization. I should have introduced this. So horizontal axis has, again, 10 million traded in the first row, second row, 100 million traded, and in the columns, you see the market capitalization from 1 billion up to 100 billion. And as you can see on the right top chart, for instance, if you have firms with a very large market capitalization of more than 100 billion, the price impact is much smaller. So it's in the range of 2 to up to 6% max. Now, this was the result of the analysis, which is like, say, the first block of our model. And now I show you how we use this in the system-wide stress testing context. And here I show you the results for the version of the model that includes banks and investment funds. And so this is a model where we basically build a whom-to-whom relationship of all the entities that we cover in our system. And here you see a view of the securities holdings with the banks in the center. So this is a real network chart on the right-hand side, and there are links to the other sectors in the system with granular securities data. So this is covering 7% of bank total assets. And how this works is basically in the simulation that we can do to generate fire sales, we have basically the main impact coming from liquidity shortfalls. So banks and funds need to cover their liquidity shortfalls by selling tradable assets. And that is done by a pro rata approach and leads ultimately to a new price equilibrium. And this is achieved until there are no more further losses in our simulation that we conduct here. And yeah, let me show you what that means in practice. So we have basically here in this chart on the right-hand side, I'll show you for different quantiles, the losses in percent of total assets of the system of banks and funds. And we have tested here a homogeneous price impact parameter. That means a price impact parameter that is the same for all entities versus a heterogeneous price impact parameter that is based on the analysis that I introduced to you earlier on. And what you can see is basically that the magnitudes in terms of impact differ. So we trigger here fire sale simulations by a redemption shock for investment funds. And banks and funds suffer fire sale losses due to endogenous price drops in this overlapping portfolio setup. And ultimately, what we can see is that there is less strong impact from these fire sales if you use such a price impact parameter framework that is heterogeneous than the commonly used standard homogeneous price impact parameter that is used in the literature. And we have even done further tests here. So this 3D chart shows on the x-axis different levels of redemption shocks. So right-hand side x-axis, and on the left-hand side, different levels of price impact parameters. And on the y-axis, the losses, again, relative to total system assets. And what we see is basically here a sublinear increase in system level losses with the increase of redemptions for different price impact parameter quantiles. And let me conclude. So we estimated security level price impact parameters for different arbitrary amounts sold, which is a useful complement to standard average price impact parameters. Taking into account the heterogeneity across securities, alleviate some of the risks shown by fire sale models that apply homogeneous price impact parameters. Historical data cannot explain the future, but former crisis episodes, and these are featured in our data set, can give an indication of the severity of future price movements affecting the liquidity of all agents in the system. And what we advocate for, at least in my team, is in addition to sector-specific stress tests, since we're here at the EBA, it is important to conduct scenario-based multi-sector system-wide stress testing exercises with granular network information to shed more light on possible pockets of vulnerability in the financial system as a whole. Thank you.
Many thanks, Matthias. Now we have a discussant, Tirupan Goyal from BIS. Tirupan, the floor is yours. And in 8 minutes. Thanks.
Thanks, Samuel. I hope you can see my screen again. So thanks again for the opportunity. Again, the views are mine and not those of the BIS. So I'll quickly summarize the paper. So the motivation is quite well known that common holdings of assets implies that the fire sale of the asset by one entity can cause losses for other entities that may not have any other direct links with the former entity. And these can lead to the spirals of price declines. So against this backdrop, the goal of this paper is twofold. One is to quantify the price impact of fire sales, and then quantify what this means for contagion and therefore systemic risk. So the intuition is that price impact of the trades depend on the market depth, while contagion across entities depends on the degree and nature of portfolio similarities. And it is the product of these two forces that determines the systemic risk. So if price impact is high, but the portfolio similarities are low, then the systemic risk is low, and so on and so forth. So Matthias already covered the key findings very well, but let me quickly enumerate them. The price impact of sales is non-linear. It is concave in the volume sold. It is also heterogeneous across securities, so lower for bonds. And the intuition here is that the price of a bond approaches the face value plus the coupon as it goes towards maturity. This is well known. So that is also observed in the simulations where bonds with a smaller duration to maturity, the price impact is lower. And what this means, this heterogeneous price impact means, is that if we ignore these netting potential diversification effect and assume homogeneous impact, that would overstate the contagion. The analysis is very informative. As Matthias mentioned, the exercise to understand systemic spillovers and building a system around that. So that is definitely, so this kind of analysis feeds into that and also helps investors build more diversified portfolios. I don't want to go into this in much detail, but to me, the key idea is that because we cannot observe the buy and sell led volumes, what the important identification assumption in the paper is that when there is one-sided selling pressures or one-sided buying pressures, that is what allows the authors to identify the price impact function via the quantile regressions. And this equation, Matthias explained very well, so I'll not go over that. So overall, I think this is an extremely important paper on a very topical issue, and that this feeds into the ECB exercise is even more telling. The empirical analysis is very well disciplined by theory. The authors carefully go through the foundations of market microstructure and use that to discipline the empirical exercise. The analysis is very transparent, and that obviously facilitates replication. All of this is very relevant to also assess the March 2020 sell-off or the SVB failure, which caused the depegging of USDC for very similar issues, which is the holdings of the stable coins in similar markets. So I would highly recommend reading this paper. And in what follows, just 3 comments. One is, so as we already discussed, distinguishing between buyer-led and seller-led volumes is understandably elusive. I'm aware of this seminal paper by Kowal and Stafford from 2007, and this actually led to a large literature who adopted a slightly different approach. They use a flow-induced trade measure of buying or selling pressure. So the idea here is that there are investors that are facing large inflows at a given time. If we look at how they change their holdings and net it with the outflows, with the funds that face outflows and how they reduce their holdings, this net effect is another measure of selling or buying pressures. Obviously, this is normalized by the average trading volume in the preceding days. But I was wondering if how this approach, the flow-induced trade measure approach, compares with the approach in the paper. It will be useful to discuss the pros and cons, and perhaps the authors can use this to further sharpen their estimation strategy. But at a minimum, I think Kowal and Stafford deserves a discussion in the paper. My second comment is around the liquidation strategies. So typically, institutional investors have 2 kinds of liquidation strategies: a horizontal cut, where when they face redemptions, they reduce only the liquid assets, whereas a vertical cut is one where they reduce both the more and less liquid assets proportionally to the outflows. And this choice depends on a host of factors, such as what the liquidity buffer was, how large the shock is, and how persistent they think the shock is, right? And there is mixed evidence on when investors follow one strategy or the other. My sense is that this has important implications for the spillovers, because if the horizontal cut is used more often, and then only the cash holdings are liquidated first, then the contagion risk should be lower. So perhaps the authors could vary the pro rata liquidation assumption and see how that affects their results. And finally, a point on the nature of the nonlinearity. So the price impact is concave. I was curious as to what this implies for the loss that the seller incurs. And by my calculation, this loss function should be convex. And this means that the contagion would be exacerbated because of this convexity. Convexity in the volume of sales. So any discussion around this would be very insightful. I have some minor comments on the exposition, but let me stop here. I'll share the slides, obviously.
Many thanks, Chidupan. So now, Matthias, can you take some of these questions, and then let's see if we have also from the audience in the meantime.
Yeah, thanks a lot for your discussion. That's great. Let me just get back to you on a few of those items that you just mentioned. So regarding the horizontal cut versus vertical cut, yeah, that's an important point, obviously. And we have been discussing this at the ECB in the corresponding groups at length, and we have tested this also. Common view is when you take in particular the sell-off of March 2020, what we have seen, at least this is also empirical findings from research that was done at the ECB, was that mutual funds kept their cash buffer, so they didn't reduce it. And a waterfall type approach, so a vertical cut, was not something that was observed. We have the possibility to adjust this to take into account the liquidity of these individual assets. And you can see that there are differences, obviously, in the results. But the most important question is what is the most reasonable way to estimate it. So, and given that this is obviously very computationally quite burdensome, we are now having all kinds of options to play around this with this. What is, in my view, the key thing for the future to run simulations is to use stochastic scenarios and then play around with different calibrations when it comes to the selling, but to get, for a start, a larger distribution of the overall max losses depending on how your initial shock sizes are. Then regarding your next comment on, yeah, that's a tricky one. Concave relationship, indeed, that's what we monitor in the individual subsegment. But then you are wondering what is basically the functional form for the losses. Is it convex? We have not tested it because that would need to be the aggregate result overall, and we have not checked how. But it's a good idea. We could check how this looks overall. Ideally, also with stochastic scenarios, because just a one-off doesn't show this necessarily. It's better to see this in a larger distribution. So that will be the comment on this. And then the literature reference that you made, yeah. We are revising actually right now the paper for a journal, and I think we might have added that point, but on the pressure that you suggested to include as an element in the estimation. So this information is very difficult to get, because right now what we are facing is the following situation: that we have the holdings at a quarterly frequency, and we have the price data at a daily frequency. And what we are trying now to do is basically to move forward by feeding into our database daily price changes while keeping the quarterly holdings from Q1 to Q2. So we move onwards to learn from the price changes. But we don't have daily movements of the holdings, unfortunately. That will be hopefully one day possible, but right now it's not. But we try to proxy for that in some form, that we at least try to see what is the impact if we have daily price changes of all of these millions of securities that we have in our system, because right now the system covers not only banks and funds, it's banks, funds, insurers, and all the central bank asset holdings, and funds are worldwide. So it's quite a lot of securities that we have. And with this, we play around. Yeah, let me stop here in the interest of time.
Okay, do we have any other question from the audience? If not, So many thanks, Matthias Ido, and also Tirupan for your discussion. Let's have a break now and restart at 10:30 with a very interesting session, Big Data and Data Protection Challenges. Thanks.
We can probably start. Yeah, confirm. Okay, good. So hello, everyone. So as we start our session, I would like to present myself. I'm Marina Chernov, and I'm a senior policy expert at the EBA in the Economic and Risk Analysis Department. I have the pleasure of chairing the 5th session of the workshop, which is called Big Data and Data Protection Challenges. As my colleague just mentioned, it's a very interesting topic. I would say big topic with big challenges to be discussed. So I would just move straight away to the first paper. And I would like to invite the first speaker, Andres Chomsik Penedo, right, the co-author of the first paper, which is on data protection and privacy challenges of the digital euro. Please, 12 minutes.
Is it working? Can you hear me? Yeah, okay. So first of all, I'd like to thank the organizers for the invitation and accepting our paper to be presented here. As Marina's our chair was mentioning, the paper is structured around the challenges of the digital euro from a data protection and privacy perspective. A little bit of a disclaimer in here. It's going to be a little bit more paper, more law focused, not so much on economics, which I think has been kind of the trend overall in this workshop. So perhaps it's a little bit of a change of a pace, but this is what we do at the Brussels Privacy Hub in the Free University of Brussels. So so a little bit of a background for the paper. It's a little bit of an ongoing effort on trying to analyze the whole digital finance strategy from the European Commission from a privacy and data protection perspective. The team is composed by me as the principal investigator, and then we have 3 other colleagues from the Brussels Privacy Hub, Michal van den Poel, Pablo Trio Karamczak, and Alessandro Talda. We started the work on this topic on the digital euro almost a year ago when members of the European Parliament asked us for an opinion on the proposal that was submitted by the Commission. And from there, we move on to being supported by the European Data Protection Supervisor as one of the independent research projects that they are supporting this year as under the 20 years anniversary. So, as I said before, this paper is a little bit of a change of a pace on the overall rhythm of the conference, of the workshop, basically because we take a descriptive and theoretical legal analysis of how exactly current payment systems and particularly the digital euro work and their challenges when it comes to privacy and data protection. And basically, we're trying to address exactly how the principles, obligations, and rights that stem from the EU data protection legislation, basically the GDPR, but also the European data protection regulation, apply to the digital euro, and whether or not the current scheme that is being proposed by the Commission and is being developed by the European Central Bank actually is compatible or not with these principles, obligations, and rights. So, as a little bit of a background, kind of the digital finance strategy acknowledges all the previous work that is being done in the financial system when it comes to CBDCs, and from there it builds on the proposal that they submitted, the Commission submitted in 2023. Currently, the status of this proposal is still being discussed between the co-legislator, between the Parliament, the Council of the European Union, and the Commission. Perhaps due to the election period this year, the discussion was a little bit stalled, but we know that it is still gaining a little bit of speed again at the end as we're speaking. The thing that we've seen with this proposal is a little bit kind of this reaction towards cryptocurrencies and stablecoins and trying to propose an alternative means of payment, a public means of payment to actually react to this kind of two phenomena. And kind of our questions when we started to see the proposal and all the previous work that was being done is whether or not actually this kind of public payment system is actually truly novel in the sense that it resembles and relies a lot on the existing payment systems and of course kind of the data protection and privacy issues that surround these systems nowadays. Our starting point for this research is basically that monetary privacy matters in the sense that financial data is extremely revealing in a market-based society. all the payments that we do have a really strong possibility of actually revealing special categories of personal data. Think about a payment to a union, a payment to a political party, a payment to a religious institution. All of these, in a way, constitute special categories of personal data, and they are subject to more stringent requirements from a data protection perspective. And in a way, we kind of question the existing literature, and we tend to side with that in the sense that monetary privacy and financial privacy in general is a necessary condition for an open society. If we want to keep on living in the context of a democratic and fundamental rights society, monetary privacy is necessary. So what we see in this sense is basically that kind of the issue with cash, basically with fiat currencies, is that they're privacy by default. There is no monitoring of transactions between the parties that are involved in it. However, the status quo, kind of this mixture between cash and digital accounts, is a little bit of a point in the middle, because cash transactions are currently being limited more and more and more, and being forced to be conducted within the traditional financial system, which is obviously obliged to comply with certain obligations such as anti-money laundering, anti-fraud, etc. And obviously, the consequence that comes with the digitalization of these transactions is obviously the data processing that takes place, and this idea that this data can be processed extensively and reused for different purposes. When it comes to particularly to the case of the digital euro, we found out that even from the surveys conducted by the European Central Bank, privacy comes as one of the main concerns when it comes to the development of the digital euro. And actually, citizens want their payments to remain private, with this new solution. Turning particularly to the case of CBDCs in general, and before jumping into the analysis of the digital euro, at least our analysis from a data protection and privacy perspective, is basically that we see that exactly how these systems are being designed carry a lot of consequences for these two different rights. Basically, because the whole system of data protection is built around two main ideas: the idea of a controller and a processor. And the controller is the one that defines the means and purposes for the processing of personal data. So, in this sense, how this system is designed obviously carries consequences in this respect. Kind of the role of the European Central Bank, the role of the member states' central banks, the role of the payment service providers, exactly how each one of these operates in the context of a CBDC, and particularly in the case of the digital euro, carries consequences for the for data protection and privacy. And in the end, kind of the risk that we're seeing here is that basically there is the potential for these transactions to be monitored on a large scale basis. And of course, kind of the consequences that comes with this is that there is the possibility of a loss of trust and a chilling effect, even though there is like a no probable harm. The possibility of that harm, the possibility of that analysis comes hits very hard to citizens, as we've seen in the previous slide. That is one of the main concerns that the potential users of the digital euro have in mind. So, turning particularly to the case of the digital euro, what we're seeing here is basically the creation of a very complex architecture with a lot of intermediaries in the middle. And of course, the introduction of intermediaries from a data protection and privacy perspective comes with obligations, rights, and possible risk, in the sense that each intermediary that is involved, that has access, that has some degree of control, some degree of involvement within the data processing flow, creates potential risk. For example, the possibility of a data breach, something that we're seeing, for example, with the case of the introduction and how exactly, for example, the fraud detection system is going to be working, and and kind of how each intermediary operates in these regards. And of course, kind of the other consequence that we're seeing, or possible risk that we're seeing, is the integration of the digital euro with other systems. For example, the European Identity Wallet. Again, we're seeing kind of this trend of making something that should be simple extremely complex. Particularly, the thing that we're seeing is that even though there is this attempt to minimize the amount of personal data that is going to be processed, in the end, personal data will be processed in the context of the digital euro, triggering in that sense the application of GDPR, as I said before, GDPR and the EU data protection regulation. And it's not only about the person that is making the payment, but also the person who is receiving that payment. No, this idea that was present a lot in the Payment Service Directive too, when there was discussion on the data protection and privacy challenges, the idea that the silent parties are also affected in that sense. So basically, as a consequence of this complex architecture, the thing that we're seeing is that there is an unclear allocation of roles and responsibilities. It is unclear who is exactly a controller, who is exactly a processor, under which legal basis will the data will be processed in this context. Is it going to be public interest? For example, there are when you see all the responsibilities that each participant of the system has, there is a list of activities, and suddenly kind of the question that appeared during our research was for example, in the case of the payment service providers, if they actually provide another service beyond those, is it going to be based on another legal basis? First of all, can they do it? Secondly, under which legal basis? So it's a little bit undetermined in the sense of what can be done within this context, no? And of course, kind of the consequences, another consequence of this is whether or not there is joint controllership, whether or not they are all in the same situation, or there is a hierarchy between the involved parties. And of course, a consequence of this is actually, for example, how data subjects can exercise their rights before who is the controller responsible for responding to a right from the data subject. And kind of, and trying to wrap up, the main two issues that we see right here that we analyze in the paper is basically that we are seeing a tension between the principle of data minimization and the principle of purpose limitation, which in a way mandate that it should be processed the least amount of data possible and only related to the specific activity. And on the other hand, we're seeing a lot of data availability in the context of the digital euro, both in the case of fraud detection and in the case of AML, which triggers a lot of questions whether or not this is proportionate and whether or not this is actually justified for the case. So basically, to sum up, since I'm running out of time, our initial take on the digital euro is basically that we're seeing that the current proposal being put on the table needs serious redrafting to be more aligned with privacy and data protection. This has also been raised by both the European Data Protection Board and the European Data Protection Supervisor, that further safeguards should be introduced in order to make the digital euro both data protection compliant by default and by design. And I think that as a concluding remark, the digital euro proposal needs to censure itself on exactly what it wants to do when it comes to its expectation. Does it want to be like an equivalent of cash on a digital form? Does it want to be another alternative to existing private payment solutions? So I think that that's an unanswered question that still remains in the background, and that can configure how these challenges are going to be addressed from a data protection and privacy perspective. And that's basically it. I think that I have a few seconds left. So there are our contact information. My colleague Pablo Trigo was supposed to be joining online, but he couldn't make it in the end. So thanks a lot. I'm looking forward to the discussion and the questions afterwards.
Thank you very much. So I would like to invite the discussant, Eduardo David Martino. And in the meantime, please prepare your questions. And if there is anyone online who has questions, please include them in the chat.
Is it on now? Yes. In the meantime, I only said that I don't know much about privacy. So I learned a lot from the paper, and also my comments would be mainly on the design and perhaps on the overlaps between privacy and other policy goals. Okay, so the paper is divided in two, basically. There's a first part with some background on the digital euros and CDBC more generally, vis-a-vis the digital money and cash. And there's a second part with a hyper-detailed analysis of the privacy regime in the digital euro proposal. And this is already my first comment. You clearly see the divide. So I think in the next iteration of the paper, you should work to make the two parts a bit more integrated, so to say. So one follow directly the other, and I have some suggestion on it. First, I think let me challenge your background a bit. So especially in the first part, there's some line of argumentation that say, look, we cannot allow to have our digital euro not fully protecting privacy and not fully embedding this anonymity kind of feature because it has to compete or complement or substitute cash and digital currencies. Now, I'm not sure this holds in reality. So you mentioned in the presentation, and I think you should stress it more in the paper, there's a growing trend, and it varies country by country about limiting cash. Sometimes the limitation is by law. Belgium is 3,000, you say. Italy is lower. Sometimes the limitation is by market forces. I live in the Netherlands, and you can easily find retail shops that don't accept cash, and this is commonly accepted. It's not a matter of discussion. Of course, there's somebody who is unhappy about this, but somebody is unhappy about stuff most of the time. To operate in your business, you need a bank account. You need all sorts of stuff that de facto make cash less anonymous and less privacy-proof than it may seem at first. A very similar consideration can be done for stable coins and cryptocurrencies in general. The amount of intermediaries in crypto finance is huge. The idea that is a decentralized and trustless environment is true technologically, is a computer science problem. When it comes to operating finance in what is called decentralized finance, is everything but decentralized. There's a huge amount of intermediaries. Plus, the number of people that actually do transactions on the naked blockchain is very limited, right? Many have, I don't know how many of you got funky with crypto at some point. Many have a Coinbase wallet or similar wallets, which have very little to do with the anonymity and decentralized feature that blockchain promises, right? I mean, if you look at the FTX blow up, that was a lot of fraud also, but that's the kind of gear. So I'm not sure that's the perfect comparison, or anyway, that comparison should be qualified. Second, on competition, now is self-citation is an hateful practice, and we all engage in it as academics. I wrote something a couple of months ago, and I'm not sure that however you design a digital euro, it should be for monetary competition purposes. There's other ways that the law can curb monetary competition if monetary competition is deemed to be dangerous. It's not by setting up a new monetary, a new digital euro, a new central bank digital currencies. Central bank digital currencies can harness different efficiency gain. There's a discussion on financial inclusion. There's a discussion on efficiency of the payment system, and our payment system is not the most efficient ever. But there's other ways we can compete if needed with private money. And here, there's in the matrix, you know, you also call it in the paper account-based versus token-based, right? Creation of private account-based private money is kind of very common, and we have all sorts of financial regulation to deal with that. Stable coins are indeed a new type, at least for this from this perspective, because they're circulating private money. They're not necessarily cleared and settled at central bank level. So it's a new type of animal, and in this sense, I understand the comparison with cash. But the digital euro we are going towards is a account-based public money. Is not a token base, and this I think it also comes back when it comes to which type of privacy protection we need, right? So what type of money are we creating? What type of financial transactions will be cleared and settled there? what are the type of monetary instruments that are similar to that, which I think should drive a bit the comparison, or at least should problematize a bit more the argument. So what I would suggest you to do is to build an analytical framework, and that is privacy related, right? So when I read your paper now, and it was already less in the presentation, but when I read your paper now, is privacy is the only thing that matters. There's no alternative, there's no additional policy goal that is worth pursuing if it must come at the expense of privacy. A caveat here. The survey of the ECB and the surveys in general asking people what they care about, and they care about privacy a lot. It's great to understand what's the sentiment, but it's making the inference about adoptability is I think a big leap of faith, right? So we all care about privacy, and we all have TikTok or Coinbase on our phone. It's what we state we care about can be a bit different than what we actually care about when it counts. So setting what are the goal of privacy-related policy goals is quite important, because it's perhaps adoption is not the main one, at least not to the fullest extent. Then I would set the relevant trade-off. So what are the relevant policy goals, relevant public interests that can be at odds with privacy? And I think the ECB stated very clearly in his progress report, look, privacy is very important, but there's other things that may go in the way. I don't want to take a normative stance and say, look, they are right, they are wrong in the kind of, in how they set the trade-off, but there is a trade-off. Then I would look at relevant actors. I think the key issue analytically is distinguishing between private actors and public actors that are there, and I would do some analysis on the different remedies applied to different actors, right? It's very different to impose regulatory regime and regulatory requirement to ECB than to a payment service provider. So I think this should be analytically more distinguished in the paper. Now it's a bit, it's first iteration, right? Next iteration, I think, needs a little bit more of analytics. And last slide is basically a kind of flip of the coin of what I said. If you have analytical framework, you can do some non-formalized comparative statics, right? I have my framework. You can take one starting point that can be this model in the Digital Euro proposal, or a model where we only protect privacy, and then see what happens, how you change in the legal design, what's the impact on other relevant policy goal that can be monetary sovereignty, can be financial stability, can be whatever. But this, I think, from this very good starting point, would allow you to take the next step in a more kind of analytically rigorous way. Thanks, and sorry for being a bit long.
No worries. Thank you. So before we give you the chance to respond, let's maybe collect questions from the audience. And there is also a question on the chat. So I will read the one from the chat. Given advances in privacy coins such as Monero and Zcash, which makes it possible to transact privately, is the issue of privacy with the digital euro a policy choice rather than a technological limitation due to an unwillingness to adapt AML/TF laws? It is weird that the digital version of cash would not emulate its privacy features. So that's the question. Anyone else from the audience? So you can approach. Yeah. Yeah, so no questions. Yeah. Yeah, you can go there. Yeah.
Okay, so first of all, I'd like to thank Professor Martino for the comments. Indeed, the paper, it was on a very early stage, I would say, at this point, when it was submitted. So kind of the things that you mentioned, especially regarding the analytical framework and so forth, have been discussed within the team. Perhaps I'll probably start the last comments and then move a little bit upwards. Perhaps the main concern about being too privacy focused. That's basically what we do at the Brussels Privacy Lab. So we tend to take that stance of first of all considering that both data protection and privacy are both fundamental rights, and when they're compromised or affected, very stringent requirements are put in place. So, and I think in the last part of the paper, that is probably the one that is a little bit more messy in that sense. Kind of we put out there the discussion in these two points on the fraud detection and the AML scenario regarding whether or not the necessity for those systems is justified. Because what we are seeing in the case of the fraud detection, both the EDPB and the EDPS have been very critical of how the system is currently being contemplated in the proposal, and kind of the flexibility that it gives the ECB to design that system in a way that is, I wouldn't say without the consideration for privacy and data protection, because in the end, the ECB is still obliged to comply with the European Data Protection Regulation. It's still something that we have not seen yet. We are still missing, for example, the data protection impact assessment being conducted on this system. And obviously, we start to take, for example, in the case of fraud detection and of course AML, they're probably going to be relying on AI. And recently, the AI Act is going to be coming to the foreground. And not only just the data protection impact assessment, we're also going to be seeing a fundamental rights impact assessment. It will be necessary to be conducted before the systems can actually be deployed. So probably in that point, we can probably highlight and make more clear this trade-off, because I think that the discussion is there in the paper and probably could use some polishing to come to the foreground. And then perhaps on trying to make this connection between the first part and the second part of the paper, in that regard, I think that we were discussing a little bit in the last sessions with my colleagues was whether or not this, and I think that you pointed that point, that the current payment system is a little bit inefficient, but at the same time, that inefficiency that it comes with it because of the distributed or decentralized way that it's being structured, actually is a little bit more privacy friendly in that sense, because databases are basically disconnected. Then we can jump into the discussion whether or not this idea of the creation of the European single market for data would actually have an impact on this or not. But I think that point, it's an interesting one that could be, as you said, probably with a little bit more of merger between the parts, it could come to the foreground, because at the end is that discussion of whether or not we want a more efficient system at the expense of privacy and data protection, or whether we want a more inefficient system that allows for a little bit more room for the protection of these two fundamental rights. Yeah, and then pretty much all the other comments regarding the structure, I think that could really benefit the paper at this stage. How much time do you have left?
Well, you have 2 minutes, 1 minute and a half.
Okay.
Yeah.
Because I wanted to address the question that was raised in the chat. Yeah, basically, I think that in the end, it's a little bit of or at least our research is being hinted towards the idea that the digital euro will not be privacy friendly, because in the end, it's not going to be privacy friendly with the current structure that is put forward. It's a policy choice, not so much as a technological one, because even as part of our research, we identified that, for example, the Bank for International Settlement was working on a project that was supposed to achieve certain degree of privacy friendly solutions, even for a CBDC project. So the fact that the technological solutions are out there and they're not being chosen is probably one of the reasons. It's the policy choice in the end. It's not so much about whether or not it's technologically feasible, but it's a decision that is being made. And I think that it taps into that discussion that was presented before of whether or not this trade-off is actually being done in the proper instruments. As I was said before, like a data protection impact assessment is still missing, a fundamental rights impact assessment is still missing, and probably that discussion between policy and technological feasibility will be where this discussion will be solved. Yeah.
Thank you very much. So then we very naturally move to the next topic, which we'll probably discuss about the impact of lack of privacy. So I'm inviting our next speaker, Galina Andreeva, with the topic, the double-edged sword of big data and AI for the disadvantaged.
Thank you very much for accepting the paper. The QR code that you see on the slide will link you or will take you to the working paper online. Which is quite lengthy. I will try to do my best to squeeze all this level of detail into a very high level overview. The first author of this paper, Savina Kim, unfortunately could not be here today, but all the strengths of the paper should be attributed to her, and all omissions and mistakes are mine. Oops. The motivation of this paper, we'll wait for the slide to be on the screen. But the motivation of this paper comes from the expanding landscape of big data and artificial intelligence. So in my area, which is quantitative credit risk assessment, almost every day we hear about some new, absolutely fantastic alternative data that can be used for credit risk assessment, or some super powerful AI or machine learning algorithm that can achieve absolutely amazing predictive accuracy. And this is very, very positive, and there are multiple benefits from expanding landscape of data and technology. Yet, as we all know, every expansion comes, every technological advancement comes with some risks. The risks I am going to concentrate in this paper, in this presentation, is about financial inclusion or unintended consequences of using big data for disadvantaged or protected groups. We use open banking as just an example. I think similar problems will arise in any type of data, which is used for some kind of decision-making affecting consumers. And I will describe the data. I will provide some regulatory context so that you understand the dilemma that we are trying to address in this paper. We will demonstrate the power of open banking by looking at a specific problem, how to model or profile financial vulnerability. And this is one chunk or one area where we provide academic contributions. We develop certain quantitative measures of financial vulnerability that complement subjective survey-based measures that have been used so far. And then we try to put ourselves in the shoes of predatory lenders. What if we want to target certain vulnerable groups? Can we achieve this with the financial transactions data that we have? This is open banking is all about. And what are the implications, not only for financially vulnerable groups, but also for protected groups? We will concentrate on associations with what we call protective and sensitive attributes. I will tell a little bit more about it. And we will look at the illustrations, what actually different decision-making or different business applications mean for protected segments. Our message is mainly addresses data modelers. So I think the main message of the paper is beware of the dangers hidden in any data which may look completely neutral at the surface. But there are, I think, some relevant messages for regulators in providing some guidance to data modelers in terms of what is the best practice in dealing with this new technology and new data. Thanks to Yeah, thanks to the second Payment Services Directive, which is known also as open banking, we now have very detailed, granular data that allows the lenders to learn a lot about their consumers, their customers. But also the main advantage of this directive is really empowering the consumers. They can take their financial transactions, say from current account, and use these transactions to improve their access, to get wider access to financial products and negotiate better financial terms or contractual terms. The data that we have comes from a social lender in the UK who serves public sector workers, but a very low level of public sector, lower paid level of public sector workers. Normally, we think of this sector as being very financially resilient. We were surprised to see that there are pockets that really do not exhibit very high financial resilience. The lender uses open banking exclusively for risk assessment and for accepting customers. We had over 180 million transactions from more than 100,000 applicants over 2 years. So this is the massive data set, which requires AI. You cannot really process it manually or even with traditional statistical tools. Just imagine your bank statement that you get every month from your bank, where you have the date, amount, and a very short description of what the transaction is about. That's the kind of raw data that we used and processed in our research. These are 6 binary indicators that we've developed as measures of financial vulnerability. They are based on Financial Lives survey, which is conducted by Financial Conduct Authority in the UK. So we tried to match the questions they asked to measure financial vulnerability to objective measures we can obtain from account balance that we can observe, or we also can see the type of transaction. We can see whether the person uses maybe some gambling, maybe the person pays already some debt, pays to debt management or insolvency management companies. So, and we used all this information to create our measures or target variables of financial indicators. We also had some protective or sensitive characteristics or attributes. The equality regulations in any countries, and European Union is no exception, has the whole list of characteristics such as gender or age that cannot be used in decision making. People of different genders, ethnicities should be treated equally. In our data set, we had gender and age coming from the application form. And we also could infer certain attributes or certain characteristics using transactions. For example, disability. We could see it from benefits. We could also see whether the person had a child through the benefits, or if this person is a carer. The legal position is very straightforward in terms of what lenders and other businesses can or cannot do. So direct discrimination is totally forbidden. And in the case of algorithmic decision making, it means certain characteristics or certain attributes such as gender, or disability cannot be included into the model. However, as we are going to show, this does not really lead to equal outcome. One of the questions is really, what is the main target or the main objective? Is it equal treatment or equal outcome? However, unequal outcome can be justified. Indirect discrimination can be justified by business purposes. What we are trying to do is just to take our financial indicators and try to predict them from financially neutral data. We have developed more than 100 of different variables, and we are interested in associations. We are interested in how protected attributes can make their way into our modeling, and having this information, we can control for this. However, in many situations, the lenders will not have this information, and they will not even know that they are disadvantaging certain groups of people. Yeah, unfortunately, I'm out of time. So I will skip all these results where we show how, first of all, we'll probably show this slide as a kind of example of analysis that we are doing in the paper. Here we are trying to predict financial vulnerability indicators on the left-hand side, and also protected attributes on the right-hand side. And AUC, the higher is the better, and the best prediction is 1. So you can see that we are very close to 1 with both financial indicators, but also with protected characteristics, which means there's very strong association between financial data and any other kind of data that may be financial, that may look neutral on the surface, and things that shouldn't be used for modeling. And it is not clear to me how these associations should be treated. So there's very little guidance in terms of, this is really my message for the regulators. Any guidance in terms of how to treat these associations, I think will be highly beneficial for the practitioners and data modelers in the field. But also, even allowing to collect this sensitive data will be a huge step forward, because the lenders interpret these equal treatment principles. We will not collect the data, and then no one can accuse us of discrimination. But that means they cannot monitor the equal or unequal outcomes for these groups. Just 1 minute. If you are in credit risk, please consider attending this conference, which will happen next August in Edinburgh. And QR code will take you to call for abstracts. Thank you, and apologies for running out of time.
Okay, no worries. Thank you very much. So I will invite now the discussant, Kim Abelgren. Is he online or?
Yes, hello. Can you hear me?
Yes.
Okay, I seem to have some problems with the technique, but let me see if I can share the slides. Okay, you see the slides? You can see the slides now?
Not yet. Now, yes, yeah, we can see it.
Okay, thanks. Let me start by thanking the organizer for inviting me to just this interesting paper. The usual disclaimer applies, so my views are not necessarily shared by Danmarks Nationalbank. This is my one-page summary of the paper. The most important research question, as I see it, is that whenever there are any ethical or regulatory challenges related to the use of AI and open banking data among credit providers. And the orders they so on the slides gone.
We lost the presentation.
Okay.
Just a second. We have it. Yeah.
Okay. So and the orders they have access to a very detailed data set with 180 million transactions record from 100,000 customers, and they reach two main conclusions. First, that such granular open banking data, they're very useful for credit scoring applicants. But the flip side of the coin of this very detailed data is that it's also possible to infer some protected or sensitive personal characteristics from the data, even in cases where these characteristics, protected characteristics, are not part of the underlying data. And that is because of the correlation between these protected characteristics and then other attributes of the data set. And the main policy implication of this is that here might be an issue for supervisors and regulators to look at in order to make sure that we can ensure privacy and fairness in credit application. So my overall assessment of the paper is that it's very well written and easy to follow. It deals with an interesting and very topical issue based on a comprehensive empirical study where they use state-of-the-art big data methods. And there is a clear contribution from the paper. It is one of the first, if not the first, paper that deals with these ethical issues based on real-life open banking data. So I have three more specific comments to the paper I would like to add. First, I think it would be useful for the reader if you early on in the paper have a table with a list all the protected characteristics that you look at, and also describe which legislation they come from. I think that will help the reader to maintain an overview while you go through the data. And the second comment is in relation to correlation versus causality. You clearly state in the paper that you're not looking at causality, but only at correlations and associations. And that's fine. But I think that the readers could benefit if you try to describe which data do you need in order to be able to establish causality. I guess that you will need a kind of a natural experiment. So have you seen such kind of a natural experiment in these recent years, or what type of natural experiment would we need? And my third comment relates to your recommendation for supervisors and regulators. I think it would be helpful if you can be a little more concrete there. Should we, for instance, try to limit the scope of data that can be obtained under open banking, or should supervisors evaluate or audit the AI tools used by credit providers? So where in the range of possible actions do you think we should be? So let me sum up. I think it's a great paper. It presents a very interesting and deep empirical analysis of a topical issue, and I hope that you will be able to place it in a good journal. So I wish you the best in your future work on the paper. Thanks.
Thank you very much. Are there any questions in the audience? So far, there is nothing in the chat. Yes, Rafael.
Yeah, Rafael Kopp from EBA. I mean, I don't know the paper in detail. I just heard it now for the first time in the presentation. But there is also this paper from Fuster and co-authors, which do something very similar. I think they show on the one hand that this greater flexibility in terms of the machine learning methods introduces some disparities, and also that, if I remember correctly, they also show that they're able to uncover some hidden information. So I would be interested to hear what's the difference there.
Many thanks to the discussant for very helpful observations and suggestions. Yes, we will include the table. Many thanks for the suggestion. In terms of correlation and causality, we deliberately in this paper concentrated on correlations because in our understanding this is really the first step before moving to causality, but also the message is really, even if you build models that are based on correlations and maybe if you build the models based on correlations, you should be super vigilant because these correlations may play the trick and you may find yourself in the zone where you don't really want to be, with some customers complaining about unfair decisions. For causality, that will be a completely different research and completely different research design. And unfortunately, at this stage, I'm not prepared to say what the research design will be. I'm very open to suggestions and would appreciate any advice in terms of any potential natural experiments or instrumental variables or any other approaches that we may use in future. More concrete recommendations, yes, we will try to phrase it in a more straightforward and concrete way. And regarding the paper from Fuster, I think they concentrated mainly on the algorithmic side, on machine learning side. We are trying to show, yes, there is a kind of a link to data, but they don't really spend much time talking about the data. I see our contribution as really showing that any data can be problematic. And it's not surprising, as we expand the data and we improve the algorithms, our profiling will become more and more accurate. And this is something that we need to keep in mind. The regulators, the data modelers, the lenders, everyone who works with the data and AI.
Paper that was done by a working group that was shared within AFR, which is a think tank, with the objective to provide a recommendation to the regulation and have debate paper. And the working group has been chaired by Pervenche Berez and Véronique. Véronique, you want to do a short introduction?
Yes, thank you very much, Rami. I just wanted to, and sorry for joining a bit late, I had problems for connecting from Brussels. First of all, I just wanted to thank the EBA for selecting our paper for this policy workshop, and as an ex-member of the EBA Banking Stakeholder Group, I'm particularly delighted to be part of this event today. But being on the line, I guess I will hand over to Rami for the presentation of the paper. Thank you very much.
Thank you, Véronique. So the paper is on the theme of transition plan and basically discussing their comparability, credibility, and effectiveness. And I will come back on the credibility issue throughout the presentation, and probably we'll have discussion afterwards. I think the idea of this debate paper was twofold. One, the importance of the transition and the transition plan in that context. And second, a bit of confusion about what it means in practice and where we should head at. And typically, then we assessed and analyzed this in the working group, looking at these dimensions. I won't go through all the paper, but mainly focus on a couple of points, which I think are based on our analysis and will help to understand the recommendation we put in the paper, which I will sum up in the end. So I will jump in some point and analysis. The first one, well, just to recall that transition is still paramount, and there's been, the recent UN emission gap report that is basically telling us that we are departing from the 1.5 goal unless we do something serious. Something serious is about transition. And I'm sure that the result of the US election yesterday will ease the target. Having said that, in order to do this, it requires the action of many actors. We mentioned three. It's a collective endeavor, and we go to say that if one of these stakeholders doesn't do its job, then it's unlikely that the transition will happen. And who are these stakeholders? So we have the public authority, which basically should give the target and provide the economic condition to make the transition happen. The supervisor and the regulator with two elements. One is to provide the tools for the various stakeholders to be able to manage the transition. I will come back to this with example after this, and also obviously to ensure a level playing field and to monitor. And then the private sector, who is going to implement in practice the transition with a special element with the financial institution who can provide the fund for the transition to happen. Again, it's a triangle of responsibility. Probably, if one of these actors doesn't do his job, then it won't happen or will happen too late. And the transition plan is, in essence, the information flow that will enable all these actors to understand each other, to see what others are doing, so that they can have informed decision. So you see the importance of transition plan. It's a kind of language. Hence, to the first point that we highlighted in the report is that in terms of language, it's a problem because there's not one language. There are multiple languages. And it's a bit normal because it's a bit complex, but even if when you break it down, you don't have one uniform definition of transition plan. So broadly, it's the same thing. But when you look, is it 1.5, below 2 degrees, something in between? There are some nuances, which at the end are important. If you look at the various framework that describe what the transition plan should look like, again, there are many of them. So some are not addressing the same type of objective. So from the scenario to what the transition plan framework to how we assess it, how we disclose it. But still, even when they want to address the same thing, there are very, very different way of seeing a transition plan. And looking at the scenario in particular, for instance, you would see that between some core scenarios that are used, they are not always aligned on the main assumption, main information, and cannot be reconciled easily. So a language problem. Then there are some dimensions in transition plan also that are treated a bit differently. So one element that was highlighted by the NGFS StockTech, which is one of the paper we use and analyze in our debate paper, is that there's a difference of perspective between the strategy and risk management approach. And we're in the EBA here, so we thought that we could put some development on this. So basically, some transition plan are looking at risk management, so we'll develop an element of risk management, and others say, well, we are going to define on the strategy and the developing thing on the strategy aspect. What we are saying is that actually we cannot disentangle them. Actually, they are very linked, if not the same thing. Once you have set the strategy, this is where a risk happen. I'm trying to illustrate this in this shallow chart. So you have set your strategy, it's a blue line. Two things can happen. One is that you are not able to execute the strategy, and then you depart from this blue line, and then you create risk. And this is where people should look, regulator, auditor, whoever, to see if we are departing from the strategy. And the other thing that can happen is that because we are looking at a very long horizon that will go to 2050, actually, maybe you're not in the right place in your strategy. Something else will happen. And instead of when you're in the blue line, but the reality is somewhere else, and you need to measure the difference. And this is where scenario analysis is important to see on your strategy what are the vulnerabilities. By the way, you can be very good in terms of climate, so totally aligned with the 1.5 degree, and still, because the state of the economy is not there, you produce electrical battery and the technology change, or you're not able to sell it anymore, you can be in a financial problem and have risk management purpose. And then the other theme, before I go to the recommendation, I want to highlight is the distinction. Again, it was clearly mentioned in the NGFS StockTech paper between transition plan and transition planning. Why is it important? Because actually, transition plan is about actions. And when we think about transition plan, we think about disclosure. Transition planning is about what you're going to do in the various institutions. I don't think it's reasonable to think that everything will be disclosed about your action in a company, in strategy, in full detail. You'll have a summary that will be disclosed. And this is what we wanted to summarize this, which doesn't mean that you don't have to do other things. And then if you have other things, then you can make sure that by doing the other things well, what is disclosed is credible. So I think there's a link between the two, and we need transition planning that will explain how you do your transition plan. Typically, two elements that are important. We talked about scenario and target. There are a lot of work to be done to analyze the scenario, to see how much they're relevant. I mean, in the world of modeling, it's model risk management framework. That is important, but you're not going to disclose all this. Or you have action to take into account when you decide that you have taken a direction in terms of net zero type of objective. This has to be implemented deeply in the various processes of an organization, and that's our very precise action that would be in transition planning, but not necessarily in transition plan. Hence the recommendation. So I will go through them quickly, but they flow basically from the various points I mentioned. Not all companies will have to disclose or to develop a transition plan. And I'm thinking about the small company. We say, since it's a collective endeavor, excluding a part of the economy doesn't really make sense. Understand the problem of proportionality, but there should be some incentive to do it. Second one, there should be unique transition plan, because you cannot have various plan, various action which are different from another, and then you add building blocks. And I think it's important because, again, in the EBA context, we have the CSRD on one side, and we have the prudential transition plan, and it's be weird to think that these things are two different things. Third, we should construct on existing requirement. So we have a European regulatory framework, which is complex, but is there, and including the CSRD, which has some prescription on transition plan. We need transition planning guidelines. We put example in the report, but basically think we should be developed by a public authority. How do you do a good transition plan, and how do you have a transition planning in your organization? It has to be supported by public policies. If you think about credible transition plan, we can decide to go to 1.5 degree, but if the states and the economy is not there, and I'm thinking about bank who at the whole will be financing the economy, someone will be lying at a certain point. So without public policy, the goal won't be able to be achieved. If, again, we are serious, we can think about a way of monitoring this public policy at the European level, the way you do it with the Maastricht criteria. European supervisory and regulatory entity should have a line approach, and this is a link between having a unique transition plan, for instance. Scenario will be very important because this is the target you're going to go, but there are various assumptions that are not very clear on the scenario, not aligned, and not easy to be reused and challenged. And at a certain point, if we think about, the EAE, which is currently in the bank setting the target, and the NGFS, which is looking at the risk element, we should be able to reconcile both of them to be able to have a complete picture. We need to have external assessment to assess credibility. What we mentioned in the paper, that in order to do this, you need to have the tools, including this transition planning guidelines. This should be the basis for transition finance. So not looking at what's green, like taxonomy, or what's at the target, or green bond, but really thinking about transition, and transition finance can only be supported by transition plans which are credible. And then lastly, we mentioned, we worked on the transition plan on the climate risk mitigation, but the other subject, and thinking about adaptation, which will be more and more important, and obviously biodiversity as well. So that was the close and the end. I'm on time, probably, no?
Absolutely. So thank you very much for that. The discussion for the paper will be Thomas Robetier from EBA. So please, yes, sir. Oh, yeah, no, you should go there. Yeah. So you have like 6 minutes for the, thank you. And just a brief reminder, if all the virtual participants, please could double check that their microphones are muted, because we had some background noise in the previous speaker. Thank you.
There's no red button. All right. So good. Well, it's 12 noon, so good, whatever. Good everything. I'm Thomas. I am detached at EBA for 2 years from the ECB, and at the ECB, I was overseeing ESG on-site inspections as head of mission for the ECB. So I'm happy to have reviewed your text. I think it's a collective effort. Let me say first that I welcome all the proposal. Some are not new, but repetition is the base of pedagogy. So it's good that we're here. And I'm happy to say that although our guidelines on risk management at EBA are not final yet, some of your recommendations are actually part of those risk management guidelines. Since they were repetitive, we finally heard you. No, but so very interesting paper. Obviously, in my role as I try to help as a policy expert, writing on the risk management guidelines of the EBA will soon publish. I read a lot of paper and proposals about transition plan. Yet, as we discussed a little bit, and I will take extract from your paper, your collective paper, and I will start with, I think, a topic that is a little bit timely, but you talk about rising doubts, right? About ESG risk integration, the purpose, all of that, and even in the introduction. And I would like to know whether you think rising doubts are genuine or convenient excuse. And feel free to. I do not know exactly the format. So, is it supposed to be you're going to reply to me afterwards? So, I'll make my full. But what I'm very interested in is there's a couple of papers that just came out as well, which is a bit the first mover curse. And if you look at your chart, you remember above, and those who go too fast, too early seems also to be in pain. Too long seems to be in pain for other reasons. So what's the right timing? And is there rising doubts because it's convenient or because there's a first mover curse? And that really I would like to have your views. The second, and which we discussed a little bit, is the non-financial corporate transition plan analysis by banks. So I was 2 days ago in Luxembourg meeting my colleague from inspection, and there were a lot of worries raised by banks about, are we supposed to give a grade or pass or fail or something like that about the transition plans of our client? We already have a hard time putting our transition plan together. Do we need to be experts of transition plan analysis for our clients as well? Do we need to, well, you got the point, I think, but this is really creating a worries, and it's probably part of the overall assessment topic. Now, one, I would say, quote battle with quotes here, but I tried to fight, knowing that for 7 years before I was heading inspection for business model and strategy at banks. So I had plenty of time to look how the strategic process and the strategy of banks were constructed or were efficient or unfolded as expected. And as you rightly say, so the transition planning phase is way, way more important than the transition plan. I would say, as a bit of a critic, it comes a bit late in your paper, if you allow me. But if you look at our guidelines, how they were proposed, for example, a year ago and how they are now, now there's a big chapter on transition planning and a much smaller on plans. The plans are the output. The plan is, as you explain, the steps that will be taken, but the reflection, the decision, the data available for decision, why one way or another, and so forth, that's to supervisors, regulators, and probably auditors, the key. How can we emphasize that? Because there seems to be a misunderstanding sometimes at banks on this matter. Then a fourth point is external assessment. We talked about it. Every time I raise the question when the commission is here, whatever, what is this limited assessment on CSRD? And what are you expecting prudential supervisors like ECB, for example, to do on transition plan? Again, is it a pass-fail? Is it adequate, inadequate? Needs to be rewritten? Are you going to give some kind of certification? All of that is so essential to the credibility. But it's a huge topic. If you have a minute and really you go fast, we can talk about ESG rating, but that's the icing on the cake. So, voila. Shall I
I think we should conclude here because we may have some questions also from the audience. So thank you. So do we have any questions from the floor? No, not for the moment, and also from the chat, we don't have any. So please, Rami, if you want to respond.
Well, thank you first for having gone through the paper and your remark. Is it convenient or not in terms of in the first mover curse? I would say yes, but on both sides basically. So if you open the possibility of having doubt, uncertainty, you will find those people who say, well, why I'm going to be the first mover, and those who don't want to do anything. And this is why, we wanted to put this also in the triangle responsibility and remind the importance of public policy, because that makes a big difference. If you have some certainty where you're heading in terms of direction, and certainty also about the economic conditions as well. So we talked to in our we did actually some 25 interview, and there was a steel maker, and he was saying, well, this is my strategy, but it's will dependent on affordable and abundant energy at some times, and if doesn't happen, well, the transition won't happen. So this is where we need the direction. And speaking of where we are today, we are on turning point, I think, on this as well, because of all this uncertainty, the less clear you are, you have more and more people that will find excuse, right or wrong, not to do things. But we are shifting now, and I think it's more than ever important to give clarity. And if you think of banks, first mover, I mean, where you are a company, you can still decide to do electric cars. You're called Tesla. You take a bet, and it's going to work or not, and then at the end, it's good. Banks are financing the whole economy. So if you look at all the big banks, they are financing the whole economy. So this niche bet is not possible. So they are dependent on where the economy will happen. Then assessing the transition plan of the counterparty, I think it's the core of what we're talking about, and the rest should be less relevant. I'm not going to say irrelevant, but less relevant. It's at the end spending time, resources to understand what the counterparty is doing. Hence, looking at transition plan, either through disclosed information or through direct information. And this is where it should happen. I don't see how we can avoid this. It's complex because you need to have the information, you need to have the people, but I think it's inevitable. Your third point, sorry, was linked to this, if I remember.
Yeah, unfortunately, you need to be very, very quick because we have to close the for the next speaker.
Yeah. So there is
maybe, if I may, there was a point on rising doubts. So maybe I can be very, very quick on this. The rising doubts we thought was important to mention, because we do see from the society rising doubts about transition, and precisely as you said, some of the civil society consider that transition is a way to delay or is an excuse not to do things more quickly. And so I think the whole purpose of this paper was, in a sense, to address those doubts and say, no, transition plans can be credible. There are conditions needed in terms of content, consistency of scenarios and governance, transition planning, for them to be credible. But we do need to recreate or create trust in the transition plans. Otherwise, the transition is not going to happen, because we see like fund management industry being prudent in the way they invest due to the kind of lack of clarity on what is a transition plan, what is transition, and that is absolutely critical to channel the investments needed. That's why we were mentioning rising doubts, not so much from the financial institutions or banks, but rather from the civil society and therefore the investors.
So two words on external assessment, and I will do it with my words. But basically, what you would expect from should expect from the auditor is saying, well, the transition plan that is disclosed is what the company is doing, and what they're saying, it's 1.5. Yes, it's 1.5. We're saying they're taking action. Yes, they're taking action. Now there's a question of the depth, or where you can do this and how it will be done. And I think it should take time. But this is basically what you can do. And I think this is providing value to the reader. It won't say it's good or it's not good to do this because you're not aligned with 1.5. That's not the purpose. But I think bringing comfort to the reader about the information he's getting, it's good and reflective. I think this is why we have value.
Excellent. Thank you. Thank you very much. So we are ready to move on to the next paper in our session, which is presented by Klaus Schack from University of Bristol. The title of presentation is Climate Stress Tests, Bank Lending and the Transition to the Carbon Neutral Economy.
Yeah. Okay. So, thank you very much for having me to the organizers. Pleasure to be here. So we've already heard from the previous presenter a lot about the transition to the carbon neutral economy, and we are trying to add to this debate with our paper by looking at the very specific role of climate stress tests. Okay, so what we try to do in this paper is we pick out the French climate pilot exercise, combine information about the banks that participated in this exercise with information about carbon emissions of their borrowers, borrower environmental performance information, and syndicated loan data to ask two research questions. The first one is we want to know what is the role of climate stress tests in affecting the way banks go about their lending behavior? Does it affect credit supply? Does it affect the pricing of loans, in particular of loans to brown firms, firms that pollute the environment? And the second question is we try to take it one step further and say, okay, let's assume a borrower gets a loan from a bank that participated in this climate pilot exercise. Does it also affect the borrower's transition plans, the borrower's environmental performance? So that's directly related to the previous paper. In a nutshell, what we find when we look at the first question, very much it's obvious that these climate stress tests or the climate pilot exercise, I use these terms interchangeably, they really help produce or generate new information that helps the bankers to understand more about exposures to climate risks, in particular transition risks, and that essentially helps them refine the information signals that they get when they interact with their borrowers. And what we document then is that banks that are aware that their borrowers are exposed to transition risks, they are polluting the environment, they are actually increasing lending volumes, but at the same time, they are also pricing the greater risk arising from climate risks appropriately, meaning they increase loan rates. And there are some tests that I will show you that make it very obvious that really there is new information being generated as part of these climate stress tests. The second dimension of our analysis, as I said, we look into the fact of what are borrowers doing. Here we have some encouraging news, encouraging in the sense that borrowers that are known to be polluting the environment, they respond to this greater awareness that they infer from their interactions with the bankers, that they also tend to start developing new eco-friendly products, they develop emission policies, they commit to reducing carbon emissions, they have also higher ESG scores and use higher shares of renewable energy sources. But then when it comes to the really tough choices that the corporations have to make in terms of greening their supply chains and so on, that's where the evidence gets a bit less convincing. So let's look into the details, if the slides won't allow me to move on. Yeah. So as I said, we use information about syndicated loans. These loans are originated to French borrowers between 2015 and 2023 from LPC DealScan. They are either originated by French banks that participate in this climate pilot exercise or by foreign banks that by definition couldn't have participated in this exercise as a control group. We get rid of the financial firms and we are only interested in the lead arrangers' behavior. And that information is then combined with information about lender characteristics, borrower characteristics, and borrower carbon emissions and their environmental performance. On top of that, to support our claims about the information being generated in this climate pilot exercise, we also read all 4 co-authors read through like 1,500 conference call transcripts to infer information about what is being discussed there. So I give you essentially the most important result of this paper in this slide. The way we go about the estimation is we focus on a triple difference estimator. So we have a treatment dummy that is signaling whether the bank participated in the French climate exercise, whether their borrower is classified as a high emitter. That means in the year prior to the climate pilot exercise, the carbon emissions were above the median in the sample, and a dummy for the period after the French climate pilot exercise. And we focus on loan amounts and spreads here. The difference between the first and the third column is that we include or exclude control variables. And what you see here is a very, very strong result that loan amounts for the borrowers that are polluting the environment increase if the loan comes from a bank that participated in the climate pilot exercise. At the same time, the spreads are also increasing. And if you want me to quantify this, these loans are really, really large loans. So the economic magnitude is about 200 million euro in terms of the volume and about 17 basis points for the loan spread. How would we interpret that? We have a very positive way of looking at this. We believe that this greater awareness and better understanding of the banks that participate in this climate exercise makes them realize they need to accompany these brown borrowers, that's the way we refer to them throughout the paper, in that transition to the carbon neutral economy. At the same time, they are willing to help these borrowers in the transition, but this doesn't come for free. That's why the spread is also increasing. That was unintended. Can you get my slides back? And we have some more results to back up the claim that these banks are helping the transition towards a more carbon neutral economy. So we tried to do the following. We try to look really at a more granular level at the lending activities that these banks that participate in the climate pilot exercise do. We look at the types of loans that they originate. So we go through the loan purpose remark in LPC deal scan, and we essentially code a loan as being a green loan if phrases or words come up like wind farms, solar energy, decarbonization, sustainability linked loans, energy efficiency, renewable activities, storage, battery, science-based targets. And for loans that satisfy this criteria, we code them as a green loan. And what column 5 and 6 on this table show you is that banks that participate in this climate pilot exercise, they are more likely to originate one of those green loans. We then also look in column 7 and 8 into portfolio composition of those banks in terms of their lending portfolio, and the share of green loans is also significantly increasing. So again, that seems to suggest there is something happening in these banks after they participate in this climate exercise, that they realize that we need to do something to help that transition to net zero. And this is now where our story about information production comes in. I wait for the slides to reappear again. What we try to do is to say, let's back up this claim about information production, because when you read through the documents of that are provided by the French regulator, but it's even more obvious when you read the documents that the ECB published after its climate stress test, they really view this as an information production exercise. And if that is correct, if there is new information being obtained through all those Q&A sessions that the French regulator had with the banks, bilateral interviews were being held, feedback sessions were being held. So then there should be also, that should be reflected in the communication of those banks with the public, with their investors, but also with their borrowers. Just doesn't want to react to me anymore. Yeah, okay. So what we did is we read through the earnings transcripts of those banks. And I'm not going to read out all the details, but when you do that, it becomes very obvious that they are talking about this in a very pronounced manner. So the last example on this slide makes it very obvious. BNP Paribas says that they are building up a group of 250 professionals only dealing with the green transition. They are giving themselves targets. And we try to make use of that information from reading through those documents empirically, and keeps disappearing every time. And we run regressions, coding information about whether in the conference calls, this information is being mentioned, and whether for banks that participate in this climate pilot exercise communicate more about the green transition. Doesn't continue. Yeah. So here we are. The empirical tests support exactly what I'm saying. So they mention more frequently climate stress test in the communication with the investors. They communicate also more frequently with borrowers on transition risk, and they discuss more about carbon emissions. So that's the empirical evidence for the information production. I'm already getting a signal that I'm probably having only 4 minutes left. So let's look into the second dimension of our analysis and look at whether the firms, the borrowers, respond once they get a loan from a climate stress tested bank. And here you see 6 regressions that essentially capture information about whether the firms are developing eco-friendly products, their ESG scores are increasing, the environmental score is increasing, emission scores are responding to it, or they give themselves emission policies or target emissions. and we always have a positive and significant effect. So firms are doing something in response to getting a loan from a climate stress tested bank. That's the nice part of this dimension of the analysis. Where it's a little bit more deflating is to look at the long-term analysis, where we look into the things that are more difficult to adjust, like a longer-term perspective of greening the supply chain, terminating relationships with environmentally unfriendly suppliers, or giving themselves supply chain policies. And what you see here is there is actually little to no evidence that these things that are more difficult to adjust, it might, however, also take much longer to be adjusted, because how quickly can you, as an automobile manufacturer, completely change your supply chain? I mean, this is a very complicated thing, and Germany suffers quite a bit from this at the moment. So it's maybe not too surprising that these final results are not as pronounced yet. This might be a matter of redoing the numbers in 1 or 2 years' time, and then maybe that looks better as well. I have one more slide. We've done a bit more testing in the last couple of months, so we also know that the findings or the coefficients behave in a plausibly intuitive manner. If a bank is a signatory of the UN Principles of Responsible Banking, these effects are even more pronounced. That's not surprising. We've also looked into the role of institutional investors, where they are, as an alternative explanation, pushing banks to become greener and have greener lending activities. That's again supported in the data. We also know that there are no anticipation effects, so we played around with the variables about the sequencing. We also try to get rid of the year 2022 onwards, because there's also an ECB climate stress test that came, and we are interested in the causal effect of the French climate pilot exercise. So that's why we got rid of the data that is closer to the ECB climate stress test. We also know that other bank and borrower characteristics are not confounding our inferences. And we even know that different ways of measuring borrowers' exposure to carbon transition risk, they don't change our findings. And I hope I stuck to my 15 minutes, and now I'm looking forward to the discussion.
Thank you. Thank you very much for staying with time. So the discussion of the paper is Jorge Miguel Bravo from Universidad Nova de Lisbon.
Good morning to all. Thank you for having me here. I will share my screen with a couple of slides. So please let me know if you can see it well. Yeah, do you confirm you're watching my screen? Yeah.
Yes, we can see.
Oh, thank you very much. So thank you very much for an invitation to take part in the workshop as discussed of the paper on climate stress tests. It was a very interesting paper to read and review, and both on the research questions and the empirical findings, they are quite relevant. And what I'm going to do is basically to summarize a little bit my view on the research questions, on the main empirical results, and then raise some points and additional questions to the authors that might be interesting for them to pursue their research. So the main research questions addressed by the paper are basically whether can bank supervisors' efforts to combat climate change affect the bank's lending and borrowers' transition to a carbon neutral economy. So basically, whether the use of this specific regulatory instrument can ultimately impact the borrower's transition to the carbon neutral economy. We've seen that the results are mixed. And then the second main question was basically how supervisory efforts to understand the risks arising from climate change affect the lending decisions, conditional on the borrower's exposure to transition risk. So, and then of course the natural interpretation of this research question, or sort of sideline extension of this research question, is to what extent these supervisory efforts are more effective than other alternatives, like the use of carbon-related capital requirements, or ultimately the use of fiscal policy through carbon taxes. This is a question that needs to be raised, not specifically by this paper, but of course for a more general discussion on the supervisory efforts. Then a sideline question that emerges from this point is, to what extent are banking institutions already mapping out climate risks and the transmission channels to their financial and non-financial risks? And this is something I think requires a more comprehensive agenda to understand what are the transmission channels of climate risk to the businesses. And a third question, which I'm going to eventually elaborate a little bit at the end, is how can climate risk considerations be incorporated through the credit risk life cycle? We've seen here some first transmission mechanisms in place, mostly through the information cycle. But of course, I think for a more comprehensive understanding how ultimately getting more information on the practices of borrowers and on their carbon emissions affect the overall credit life cycle, and of course, ultimately the practices of the overall banking system. So a third main research question was how borrowers' business models are affected by the supervisor's action. So basically, to what extent they change their behavior as part of the normal business relationship with their bank, knowing that their banks are now more concerned about climate risks. And we've seen also here that there are essentially differences between the short term and in the long term. And the assumption that the paper takes is that climate stress tests are a sort of information production exercise that allows banks to get additional information on their borrowers' exposure to climate change. And this ultimately impacts through the credit supply and also on the pricing. Okay, the main findings we've seen already. So banks increase their lending supply to high carbon emitters. The results estimate 38% plus, which is quite significant. Also, they charge higher interest rates. So the way, I think the benevolent way that the authors read this is that by getting additional information on the exposure of the borrowing entities to climate risk, they are ultimately better able to estimate the risk of the lending practices and charge it through the higher spread. It is estimated in 16 basis points. Of course, the climate stress tests do not automatically trigger capital charges, but they do it apparently indirectly through the collection of additional information on the borrower's risk. And also, the paper concludes.
Sorry, Jorge, you have 1 minute left. We have to.
Okay, so very briefly. So sorry for it. So on top of this, of course, there is an issue of what is the impact of the collecting new information about climate risks on the lending practices, and this of course calls our attention on the use of the information from earnings calls. There is a complete literature on using earnings calls information, and I'll go straight to my final questions, which are to the authors. So how can climate risk considerations be incorporated through the credit risk life cycle? And we have here many possible pathways to do it, as I'm assuming that almost all of these stages of the credit life cycle are going to be impacted by climate risk, how this will ultimately impact the credit risk management and the contribution of the banking sector to the carbon neutral future. And finally, this is my final point, I believe the overall industry has to better map the impact of climate risks and the transmission channels through the economy, both at the macroeconomic level, at the macroeconomic level, and of course then understanding what are the impacts in terms of business risks, whether they are financial or non-financial. So ultimately, as for now, banks seem to be, I would say, facilitators of the transition to carbon neutral activities. Thank you for your time. So it's a very good paper. It deserves a little bit more time for the discussion, but I think it's okay for now. Thank you.
Thank you very much. Would you like to respond briefly?
Okay. Thank you, Jorge, for these detailed comments. I tried to scribble down as many of the points as you put there, but I think you were faster than me with my handwriting. So just a few points. I don't think we are trying to answer the question of whether climate stress tests are more or less efficient in terms of helping the transition to the carbon neutral economy than capital requirements. I think that's a fundamentally important question, but that's not one that we are trying to answer here. In terms of the information production exercise that you also referred to in your discussion, what I showed today is essentially our first step at this dimension of making use of the data from the earnings calls. At the moment, we have an intern for 3 months at IWH in Halle who is essentially going through a lot of these documents from the banks so that we gather additional information, that we have additional empirical tests to have more evidence that there is really information being provided. I agree with you that we probably need to work a bit harder on the mapping of the transition channels and the climate risks. What I didn't say in my presentation is that this climate pilot exercise, and I will learn more because next week I'm going to the French regulator for a seminar and talk to people. So I will learn more about my own paper in these discussions and probably find out new surprising things. As far as I understand from reading the documents for the banking industry, because they also included the insurance companies in France in this exercise initially, and we only focus on the bank. The focus was on physical risk for the insurers and on transition risks for the banking industry. That's why essentially our discussion or our description of the test focuses primarily on transition risks. And one other point that I managed to scribble down while you were presenting your discussion was you were referring to also other rules about disclosure requirements. But these disclosure requirements would apply to all banks. What we are trying to do is to pin down the causal effect arising from these climate stress tests, and like the disclosure requirements would apply to all of them. So the effect that we uncover is above and beyond disclosure requirements that exist. And maybe we should open the floor now for some other questions. And I'm looking forward to getting your slides.
Okay, thank you very much. In the interest of time, I would suggest that we take the questions during the lunch break we discuss, because we need to move on to the next keynote speaker. We have also at least one question on the online, so we will forward this question to the author and the discussant afterwards. So thank you very much for that. And now finally we have arrived at our second keynote speaker session. This will be provided by Professor Stephen Cecchetti. Steve is the Rosen Family Chair in International Finance at the Brandeis International Business School in the United States. He's also a research associate at the National Bureau of Economic Research and research fellow at the Center of Economic Policy Research. Also, he acts as a vice chair of the Advisory Scientific Committee of the European Systemic Risk Board. Formerly, Steve served as economic advisor and head of monetary policy and economic department at the Bank of International Settlements. And also earlier, he was director of research at the Federal Reserve Bank of New York. So the title of the keynote speak today is AI and Systemic Risk. Is this time different? So Steve, thank you very much for joining with us today, and the floor is yours.
Thank you. Thank you very much, Ali, and thanks for the kind introduction and for the invitation to speak. let me apologize for not being able to make the trip to Paris this week. It's been a somewhat busy week, both this week, last week, and next week. I'm going to try and share my slides, so we're hopeful that this works. So please let me know if you can. They should be visible now. Is that the case?
That's the case, yes.
Okay, thank you very much. Okay, so this is a topic that everyone's sort of been talking about and everybody's been thinking about, and I thought I would. Some time ago, I decided that it was useful to think about these things, and I tried to learn a bit about them. My somewhat engineering background led me to read and try to learn how some of them actually work. They're basically big, huge statistical models. So if you want to think about them as sort of like it's a bit like running a nonlinear regression with like 100 billion parameters. That's what these things are doing. That's what the large language models are doing. So as someone who started my first computer program was written on tape, and then I moved to cards, and then to time-shared computers and the like. This is the next step in all of this. So let me talk about technology in general first, with and then talk about AI more specifically, because the real question is whether or not AI is generating, or the current level of technology is somehow generating systemic risks that are different in character from the ones that we already have, that we already see. While we're not very good at managing and mitigating the systemic risks that we do have tools, and we think we at least understand some of the basics. So starting with the technology is obviously the key to rising standards of living. This right here is sort of like, the almost 3,000 years of technology in the payments system. Anyway, there was presumably payments before that, but they were not done with anything that looked like money. As we get over to the far right here, I should say that I'm very confused by this idea that you want to tokenize things. I think my things behave like they're tokenized already. I love paying with my phone. It's very simple, and it creates an immediate record of the settlement that I can see on my phone. But what's going on here is that things have gotten very cheap. They've gotten very fast. They're quite resilient, and they're very secure. And I think that's important to keep in mind, because AI, or technology more generally, has lots of benefits. It's lowering costs, improving quality of service, and oversight possibilities. But it has these destabilizing effects, which I'll come back to. So this is just sort of like this is a sort of introduction of where we're going. I'm going to talk about all of these things, but before I talk about these things, let's talk about what we're worried about. I should say, by the way, that I would be a very bad risk manager, because I'm very bad at nightmares, but this one's pretty easy. So other people have nightmares too. And so here are their nightmares. So for those of you that like films and science fiction, we can decide whether science fiction, how much it actually presages or forecasts reality. In the 1968 Stanley Kubrick film of the Arthur C. Clarke novel 2001: A Space Odyssey, there's a sentient general artificial intelligence computer called HAL 9000, and HAL has its own motivations, and it starts to malfunction when the spacecraft that it's basically running is close to Jupiter, and Hal realizes that there's a conflict between telling the truth to the astronauts and telling the astronauts on the spaceship the purpose of the mission, which Hal is not supposed to do. And the astronauts notice this malfunction, and they make a plan to shut Hal down. And Hal notices this, figures out that they're trying to do this, and decides to kill them. And when the astronaut Dave asks Hal to open the door so that the pod that Dave is in can go back into the spaceship, this is what Hal's response is: says, "I'm afraid I can't do that." So the real question here is that people worry about is, will AI destroy mankind? And this reminds me of this thing called the Fermi paradox, which some of you are surely aware of, which is that Enrico Fermi is a physicist of the nuclear era in the 1940s and 50s. He noted that there's a very high likelihood that there's advanced extraterrestrial life somewhere else in the universe. It'd be extremely, just vanishingly unlikely that there isn't, but we've seen no evidence of it. And so the question is why? And one resolution of this is that the technology that's needed to colonize other planets, and that would lead us to be able to contact these people, because they would be coming to us, or these entities, as it were, the extraterrestrials, that it destroys us before we can use it. And so one question is whether or not AI is going to achieve self-awareness and destroy us. I'm a congenital optimist. I think this is extraordinarily unlikely, and I guess we're going to see. It's certainly unlikely that the large language models and the AIs right now are going to get a whole lot better than they are. They'll get cheaper. They're going to get faster. They're going to get more accessible. But they're running out of data, and in fact, they're getting, because they use the data that people put into them as training material, and a lot of the data that people put in is garbage. They're getting worse at what they're doing. At least some of them are. I'll have a comment about that later. Now, technology, and if we think about technology in general, it's had a very positive impact, not just in payments, but all sorts of other things. What we think about a lot in finances is things involving information technology. And this is just a tracking of sort of the last 150 or a little bit more, almost 200 years worth of technology in terms of information transmission, and we went from a telegraph, and eventually now we have phones, which, as I suggested earlier, I'm a big fan of my phone. We all like our phones, and for those of you that don't, the way that we know that we appreciate our phones tremendously is what happens if we can't find it. And if you can't find your phone, you sort of panic. And so I've lost my phone a couple times, although I've always managed to recover it. But the interim period has been one of extreme anxiety. So if I look at this and I said, there's a lot of technological innovation that's occurred. This is the technological innovation I want to point out that is almost all of this is during my lifetime. Now I'm older, probably close to the upper support of the distribution of the people who are on this. In this workshop, but I'm not that old. I mean, I once sort of was curious, and my grandfather was born in 1896, the one I knew the best, and he was born into a world not just without airplanes or cars, but there weren't any zippers or Velcro. I mean, the amount of technological innovation we've had has been very quick and really impressive, and led to our ability to do things like me sit in Boston, Massachusetts, and speak to you in Paris or wherever you happen to be. But if I look at this list here, I can see that there are things that I would call in finance that I would call conceptual or software innovations, and IT or hardware innovations, and they're equally important. I mean, it's just as important that we have that we're able to price options as it is that we're able to transmit information and store it quickly. Because of course, if we didn't have the technology for pricing, we wouldn't. It wouldn't matter how fast we could transmit information. We wouldn't be able to share risk for sure. We wouldn't be able to trade securities. We probably wouldn't even have securities. But this list here, I think, is sort of interesting. I guess the real question right now is whether the blockchain is going to actually create any real innovation. I'm not. Again, this is sort of like, the old person's view. I've seen it all before. This is. I think of finance conceptually as a database and code. And a set of protocols for who's allowed to transfer or change the database. Okay, a change in the database would be, for example, if we were to write everything in a paper ledger and the paper ledger said who owns something, then the protocol would be who's allowed to take a writing instrument and cross out one name and put in another name. And the name would be the owner, for example. So blockchain, as far as I'm concerned, is just another database and code. I'm not sure what makes it special, except that it has a particular set of permissions that are associated with who can cross out one name and put in another name. That's really all it's about. Again, in the current parlance, that would be a clearing and settlement transaction. But in any case, you look at this and you say, okay, well, so we've had all these changes, and what's happened to systemic risk? Well, I don't know. There were runs on banks and non-banks that go back as far as the existence of fractional reserve banking. The reason that the Stockholm Banco, started by Johann Palmstruck in Stockholm in the late 17th century, failed was that they issued paper money and they issued too much of it, and the bank got run. So if you start doing certain things, if you start doing liquidity and maturity transformation, for example, and that's not the only example, you get run, and or you risk getting run. That seems that these things have not changed that. Okay, so now what about the positive effects of innovation on finance? As I suggested earlier, it makes things cheaper and faster. It also provides greater access. I already mentioned the fact that it allows the measurement and pricing of a broad range of risks. It increases the availability of securities related to the access point. It increases the volume of transactions. We get to decide whether that's a good thing or a bad thing. We might have. I'm not a huge fan of high frequency trading. I think it creates fragility without creating information, and I would put speed bumps out there. But that's another discussion. In settlement speeds can reduce counterparty risks and spillovers. The idea, for instance, of shifting settlement of securities transactions from T+2 to T+1 seems like a pretty great idea to me. T+0 instantaneous settlement, by the way, is a pretty bad idea because it doesn't take advantage of netting. So you want to be able to do as much netting as possible to economize on cash and securities portfolio of securities inventory needs, and so literally instantaneous clearing and settlement is something we shouldn't see. Maybe twice a day or something would be fine, but that would be great, and that's improving. Along with that we also improves, and I'll come back to this, the ability to monitor and mitigate vulnerabilities in the system, and it does improve security. I mean, on my list there was public key privacy, something that we use right now. Now, of course, everybody's panicking about whether or not quantum computing is going to create the ability to factor 800-digit numbers into its 2' components and recover the keys, and break the privacy, the cryptography that we are using right now. In fact, literally right now. But I think that's probably a fairly long way off. But these benefits also obviously have financial stability risks. Derivatives, which, by the way, of course, were derivatives in the form of futures markets, have existed since the 19th century. Since the 19th century. There you can have margin calls that lead to fire sales. Securitization creates these chains that have principal agent problems, and so the originators of the of the securities may not be may not have the incentive to monitor the quality sufficiently, and at the other end of the chain, the final holders of it have no clue what happened during the chain, and so you end up with mispricing of various kinds. And I also already mentioned algorithmic trading. Algorithmic trading creates flash crashes. By the way, there seems to be I've seen some reports about people who seem to be worried about AIs trading with each other. I have news for you, which is that that algorithmic bots have been trading with each other for a long time. That's what high frequency trading is. And so this is, again, not at all new. Now, this system is already pretty unstable, and if you just look at the Levin and Valencia data, which I think is the canonical source for at least the crises in the financial system since 1970, they survey 150 countries, and over that period, which is 48 years, there are 155 banking crisis episodes. The losses from this tend to be quite large, both in terms of GDP relative to trend. And again, you can decide how to measure this. There's a gazillion ways. You're always going to end up with pretty big numbers, at least in terms of the median. And similarly, the fiscal costs are quite high. So we have a system that is already very fragile. So the question then is, what threats could AI pose to financial stability here? So there are two kinds. One of them is existing threats that are then intensified and amplified. And I think this is something we might worry about. Things speed up, things get more accessible. We've got people trading securities using Robinhood on their phones or whatever app they happen to have for securities trading. So do you want people, sort of as they're sitting on the as they're sitting on the metro, they're sitting there because they've got access underground. Do you want them doing this? Is that creating problems? Is AI going to intensify those problems? Maybe I can be listening to music instead of actually doing the trading myself, while some AI bot that I've engaged is doing it for me while I'm sitting on the underground on the metro. I don't know. There's all sorts of possibilities here. But do we have adequate tools to address these intensified risks? And that's the first question. And I think that's the big question. And then the question is, are there any new? The second one is whether there are any new threats. And if there are, do we have tools to address them? And my focus is going to be mainly on the first. But first, let me talk about what AI is. AI, first of all, is something that's been around for a very long time. Depending on who you listen to and what you consider to be AI, it's certainly been around for several decades and probably longer, and it's been in use for several decades. So first of all, this is a nice picture from a paper, a June 2024 paper from the BIS, which I commend to you, by Aldasoro and co-authors. And this picture suggests, that AI is just one of the circles here. Machine learning is a type of AI. Generative AI, which is what's created all the news and is so amusing for most of us, because it has, you can just use it yourself right now if you want, instead of listening to me. And is inside of that. What's new is the ability to process unstructured data. So we're used to programs, code that we can take, say, a matrix of numbers. I don't know, you can decide how what the actual data structure is. It doesn't really matter, but it's structured, and you feed it into something and you get something out. It does some processing. Here, now what you can do is you can feed in documents, PDFs, for instance, or images, moving or still, or sound, and these things will structure them, and And they will summarize things and answer questions for you about them. The ability of this thing to synthesize large amounts of data, I think, is extremely valuable. This is a conference for the European Banking Authority. So let me mention something I heard somebody say, which really troubled me the other day. They're saying, "Oh, we ask banks to create living wills as part of the resolution procedure, and the large banks are producing living wills. These are not public documents. There are public summaries that are 20,000 pages long, and no individual can read 20,000 pages. So, but we can feed them into the AIs, and they'll summarize them for us." And I felt like telling the person, well, but you're asking the wrong question. It's not about the use of the AI. You should be asking why you've given the banks an incentive, both as a supervisor and why internally in their management they have an incentive to produce a 20,000 page document. That's obviously an attempt on their part to obfuscate what's going on. So you should be thinking about incentives, not about how to process large amounts of data. But in other cases, I think it is interesting and quite useful. So in the preparation of this talk, I actually did use an AI or several of them in several cases, and I'll come to that. So these things also interact with people, and as you use them, I'm sure your experience has been similar to mine. It feels at some level as if you're interacting with a person. It's important to understand that you're not. But that's another story. I find this definition, there's several places you can find definitions of AI. I like this Eurostat survey definition, which comes from a questionnaire on ICT use in enterprises that was done last year. Unfortunately, the survey, from my perspective, unfortunately, is about non-financial firms. I want the one about financial firms, but that's neither here nor there. We can do something like that. But this is about the fact that artificial intelligence is a whole host of things, that include machine learning, include chatbots, and include basic and autonomous robots. Although robots are not really autonomous, of course, they're not thinking. What they're doing is they're following their instruction sets based on what their sensors tell them. But in any case, I think this is a useful definition. Also, a violation of my slide creation strategies. But anyway, so here are a list of uses of AI in finance. And I have 4 categories here. A lot of them are pretty obvious. How retail investors can benefit and use these, how institutional investors can use them, how financial institutions can use them, and maybe most importantly, how the authorities can use them. And I'll come back to that to that at the end, because I think that the authorities right now are way behind. Remember, the authorities are always in an arms race with the private sector, and you got to try and stay close. But we don't know right now. We don't know what people are doing, and that's an important thing to keep in mind. We're not sure how people are using these things. And it's not even clear that I know how I'm using them, which is to say that I access a lot of sort of tools in various places, and I don't know how they're generated. I interact with websites, and I do things with voice communication, and I don't really know what's going on the other end. I don't know, how would you know if you're talking to an AI, for instance? I'm not sure how to tell. Okay, so there are a few key principles to keep in mind. The first one, which I think I know people have some disagreements about this, but I think this has been true for decades, and so I really don't understand why people might disagree with this. Financial institutions are technology companies. You can look up for individual publicly traded companies in their disclosures how much they're spending on technology, and in the U.S., the 8 U.S. Globally systemically important banks are spending $60 billion a year on technology. There are huge scale economies to this, and so in fact, this it turns out to be a massive amount of money, because it means that the individual, a number of these individual banks, the largest ones, JP Morgan, Bank of America, are spending more than $10 billion a year on technology. U.S. banking system as a whole is spending more than 100 billion. As far as I can tell, it's harder for me to get information on the EU, but the EU spending seems to be significantly lower, and I think that's a huge problem. One of the problems that's identified in the Draghi report, in that there's not sufficient investment in digitization, is what it's called there. Of course, everything's digital already. The question is whether or not you're investing to stay at the frontier. As some of what I've said has suggested already, by the time authorities see what's going on, the private sector's been doing it for years. It's really, really important to always keep this in mind. Because they're investing at the frontier, and they have a profit incentive to do that. If they don't keep up, they get killed. The authorities don't keep up, then they increase the risk of financial sector meltdowns or of failures or something like that, but they increase the risk. They don't actually get killed. And so their incentives are nowhere near as strong. And as a consequence, they're involved in an arms race that they're losing. They're going to lose it all the time, but the question is how badly. And I fear that one of the things that's happening right now is that the authorities are losing this battle, and they're falling further and further behind every minute. Okay, so what are the sources of systemic risk, and what are the regulatory responses? So this is what we have now, and it's a fairly standard list, and my guess is that all of you could make this list. It would look a little bit different, but we would all get the same things. Systemic risk is about runs, fire sales, common exposures, or if you want to call that concentration, procyclicality, and then there's also operational, it should say, cyber risk. We have a number of regulatory responses, standard regulatory responses. I always think of macroprudential responses as microprudential, like that are with add-ons, and that's really all this is. Capital and liquidity requirements, stress tests, concentration limits, and then very importantly, we have backstops in the form of central bank liquidity facilities. So now, what about AI? Okay, so this was interesting. I use I don't use this a lot, but I do use Perplexity. Perplexity is sort of like an AI aggregator, and I think this was probably using Claude to get this result. I said, what are the financial stability risks from AI? I asked the thing. And this is a summary. It was longer than this. These were the bullets in these are the headings, if you will, with some aggregation and stuff. But you look at this and you say, oh, this isn't too bad. But of course, what it's doing is it's read everything that anybody's ever written about this. It's not making up anything new. And so it's relying on the imagination of and the nightmares of people who write papers and write blogs and make podcasts and all that kind of stuff. And this is what they come up with: model risk and opacity, increased interconnectedness, the faster transmission of shocks, etc. And then there are these regulatory risks, which I think are important to keep in mind, the rapid adoption by the private sector, etc. I think this is a pretty interesting list, and I would contrast the first of all, as I said, none of these are new. But if I look and I say, well, what do the authorities see as the financial stability risks from AI? And so if I listen to, I go to conferences or I read official documents, I have a slightly more streamlined version, which is good, right? It takes effort to make things shorter, and so this concise version then only has 5 items on it, and I sort of like these. I think these are pretty good. There's complexity and opacity, uniformity and herding. This risk model monoculture thing comes. I think is really this has been around for a long time. I first started to think about this when I realized as long-term capital management was failing in 1998 when I was at the Federal Reserve Bank of New York. I sort of looked around and realized that there were everyone was piling into the same trade. And I started to think about, okay, what are the consequences of everybody learning finance in the same classes from the same textbooks? So this is again, not new. You're going to get something very, very similar regardless of what happens. So the risk model monoculture has been there forever. Ever since we knew what to call it. Interconnectedness, the world is difficult to map. The speed makes it hard to intervene, and there also are bad. There are bad guys out there. There are people who are trying to disrupt and destabilize the system. So none of these risks, as I suggest, are new. My favorite one, when I think about complexity and opacity, is to reflect. Is to do some personal reflection on my own ability to explain my decisions. Or I guess you could ask my wife. But the point is that I can't always explain my decisions, but I do make them. And I make a lot of decisions. We all make a lot of decisions, you're making decisions right now. And if I stopped you, it would be a little tedious and time consuming. But if I stopped you to try to get you to explain the decisions you'd made in the last 5 minutes, it would probably be tough going. I know, I'm focused on a particular thing. It would be easier for me to answer the question right now about the last 5 minutes. But if I'm sitting in a conference, it's harder as the audience. So the other thing is that these things are black boxes with bugs. But of course, so is my phone. And their errors are difficult to detect, but that's again not new. We live in a world of complexity, opacity, and black boxes, and we have, that's what human civilization is. There's uniformity in herding, as I suggested, that's not new. Interconnectedness, we're already unable to map the complex web of relationships in the financial system. People have been making, I think, valiant attempts, and we're I think, slowly realizing the data needs associated with that. Speed, well, as I suggest here, versions of high-frequency trading have been around for 40 years. They've gotten faster, they've gotten better, they've gotten, or worse, depending on how you think about it. I think of them as a deadweight loss on society, but remember that in the early 2000s, somebody was building a fiber optic cable that went from Chicago to New Jersey to increase the speed. This was a dedicated fiber optic cable that had to go through a bunch of mountains to be able to increase the speed at which they could arbitrage cash and futures markets in equities. So this is not new. And also malicious uses, of course, are not new. And these come from the fact both that they're intentional attempts to disrupt and there are accidents. For those of you that don't know about what happened and are worried about cyber risk and don't know what happened to the British Museum in October of last year, I suggest you figure this out. They're now finally recovering from a ransomware attack that completely corrupted their entire computer system. Okay, so can AI intensify existing risks? Well, yes. It surely can. It can intensify almost every kind of risk that you think about by making things faster and increasing access. So all of the reasons that AI is good have a flip side, almost all, that makes them bad, right? Maybe there's some additional things on here. It increases blind trust and reduces oversight. But again, think about what your phone's doing and how you trust it. I think about the fact that, if I use my phone for payments, as I did yesterday when I picked up the sushi we had for dinner, I trusted the phone and I trusted the Apple Pay system and I trusted Visa and I trusted my bank that would all work. And I didn't even think about it, right? I didn't think about all those steps. So now the most important thing here is, as this happens, if you think about the implications of much of what I've said, is that the authorities need to make large investments quickly to enable monitoring. The authorities need to be in this game, and they need to be in it now. So what they need is they need to have repositories where there's data sharing at very granular levels, and where they can do something that approximates real-time monitoring of what's going on. Now, many institutions are not producing information for the authorities quickly enough right now, because what we're going to need to understand, in fact, is things like high frequency leverage. So you look at certain kinds of trading firms and ask yourself, what's their intraday exposure? And should I know something about that? Because, of course, if they open positions that create huge exposures based on huge amounts of intraday leverage in the morning, and in the afternoon they fail, the system is going to have serious problems. And that sort of thing, I think, has been a problem for a while, but that may be getting worse. Now, we do have a large number of tools, at least in principle, that we can use for this. But again, to emphasize, what we're not doing is real-time monitoring or anything close. And if you think about bank reporting, bank supervisory reporting is still at a fairly low frequency. There's internal reporting that's going on at a very high frequency, and in some cases, on things like liquidity requirements, there's higher frequency monitoring of it by authorities, but on a lot of stuff there is not. The other thing is, do we need to be developing a supervisory AI? And I would say the answer to that is almost surely yes. The only way you're going to fight the use of AI by the private sector and the use of these powerful and fast tools is to have one yourself. Okay, so let me give you a few examples of some of the issues that are arising with AI. So the first one is that AI is extremely costly. Meta's Llama 3, by the way, or Meta creates and trains an AI that it puts out there for public use. The current version, or a version from a little while ago, had 70 billion parameters that was trained on 15 trillion tokens, which is approximately a word. In fact, a token is probably a little bit less than a word, but that's a technical issue. We don't worry about that. So that's a lot. It used 16,000 plus processors. That's $9 billion worth of hardware, and the training. We were talking. People like to talk about carbon, although that's another talk about what are we going to do now that much of the world doesn't seem to care about carbon reduction or carbon pricing, and so we're going to have to rely on the private sector. But let's not talk about that. The training was fairly costly. The OpenAI AI's ChatGPT is estimated to cost about $100,000 per day to run, because it receives apparently about 10 million queries per day. The costs are increasing. The estimate is that as we move on in the 2 generations forward, roughly in AIs, that could cost $100 billion roughly to train it. And global data centers are going to require trillions of dollars to build and maintain. And for those of you that missed this, you'll find it interesting that technology companies are looking into building nuclear reactors in order to power these. Now, one question you might ask is this a winner-take-all system? This sure looks like something that has huge fixed costs and very low marginal costs, and as a consequence is prone to concentration. And what's the remedy for this? Well, I mean, are we going to be able to have a competition policy? Are we going to be able to have broad access if there are only a few of these out there? And so we need to think about that. Now, in terms of data itself, AI is going to intensify existing data problems. And here, I mentioned the problem of scarcity and misinformation in training before. The other thing is that, of course, AI supercharges any biases and errors that are in the data. The other thing is that it gives you the illusion of precision. So there's this thing that's happening that's very weird, that with synthetic data. You want to think about synthetic data. The simplest way to think about that is that you take a whole bunch of data and you estimate something that looks like a probability density, a multivariate probability density on that data. It's like a kernel estimator. And then what you do is you take fitted values and add noise to them. And so let's say that I start out with do this in 2 dimensions. I have a line. I got 2 data points only. I draw a line through that. Let's say I estimate that line. And then I take the line and I create a bunch of synthetic fitted data and add noise to it. Then I go re-estimate the line, and now all of a sudden I think that I have a precise estimate of the slope of the line. That's obviously ridiculous, but that's what some of the stuff that people are doing. So you've got to be very, very worried, especially about the use of synthetic data. There's certain applications where synthetic data is fine, training autonomous driving cars where you have a very narrow objective and you know how to generate the data for certain circumstances on which you want the thing to focus. That works fine, but not in general. Legal and privacy risks are big. There are lots of things about who owns the data, and there are enormous free rider problems here. And in this case, they're going to create a incentive to reduce quality of data. Who's going to bother to collect data if somebody can just use it for free and feed it into these programs? It's going to be very hard to do anything about this. Now, what this does lead you to wonder, what are you going to do? Should we think about licensing and certification requirements for AI? Can we regulate and sanction code? These are questions I think that arise, and they arise even more when we think about the new risks. But these are not just financial stability risks. Is an AI going to stop responding to human commands? Is it going to alter objectives from those it was given? Or will it be given objectives that turn out to be misguided? And will it act maliciously on its own? There are all of these things create enormous externalities, and the AI firms have these things called responsible scaling policies where they say they're going to behave well. These are externalities. We can't trust them, and we also can't trust individual jurisdictions because of the spillovers. But as I suggest here, these are not just financial stability risks. So I don't have a good answer to the new risks because I'm not creative enough to think about them. But what I can do is I can use one of these things to do something which I find really, really striking. Google has something called Notebook LM. Notebook LM allows you to dump a bunch of documents, or I should say files, because they can be video, they can be any unstructured data, up to 50 items, and each one of them can be fairly large, into it, and then start asking questions, because what it does is it effectively fine-tunes Gemini, the current version of Gemini, Google's non-public AI, large language model. And then starts answering questions for you. I put 20 papers on AI and then in general, and then I asked it to generate a podcast that focuses on financial stability and AI. And if this works, I'll play you a minute and a half of the beginning of a 6.5 minute long thing.
Hey there, welcome back to the Deep Dive. Today, we're diving into the world of AI and how it could impact financial stability.
It's a hot topic for sure.
We got a ton of research on this. Papers from the OECD, a white paper about AI and consumers in finance, even some whispers from, central banks. It seems like everyone's wondering, can AI really shake things up in finance? And I mean, not just in the obvious ways.
Right. It's not just about faster transactions or anything like that. This goes deeper to the core of how stable the whole system really is.
So let's break it down. What's got everyone buzzing? What's the big draw with AI and finance?
Well, imagine a financial system that's not just quicker or whatever, but actually smarter.
Okay.
AI can look at mountains of data, way more than humans could ever handle. We're talking market trends, individual spending, even what people are saying on social media.
So it's like what? Some superpowered analyst that never sleeps.
Exactly. And because it can process so fast, AI could spot risks and opportunities in real time. That means better investments, better risk management, maybe even fewer financial meltdowns.
Okay, that sounds promising.
Yeah.
But I was reading about those old trading algorithms from the 80s, the ones involved in that 87 crash.
So let me just emphasize that is let's see, I should stop sharing. Did I stop sharing? I think I did. That was a minute and a half that was generated by the AI without any of my intervention, and it took about 4 or 5 minutes to create that. A much shorter time to create it than the podcast itself. There aren't very many controls yet on that, so I can't control, the voices. I can't give it voices. I can't tell it how long I want it to be, but that's surely coming. And I just want to emphasize that this is a tool then for us for communication and learning and organization. So I actually think about this as like a super powered version of a lot of other tools that I've used, but it does still sort of, I think, require my intervention. Let me stop there and thank you all for your attention. And I hope I haven't gone for too long, Ollie.
Thank you very, very much, Steve, for this enlightening and entertaining presentation, which I'm sure it raised a lot of thoughts among all of us, and is an excellent end to our conference. If there are any comments from the audience, I'm happy to take maybe one or two. So Klaus here, the microphone is coming. 1 second, yeah.
Klaus from the ECB. Thanks for a very inspiring talk. Stephen, when we heard about AI, I think there was an idea that you can do marvelous things that were not possible before. But if I look at use cases I see, my impression is, in the end, what these things are doing is cost saving. They are saying how much costs were saved, how much FTEs were saved somewhere to do something, but it's not doing something that is really wasn't possible before. And would you agree with this? And if yes, is this not also a bit comforting from a risk perspective? Because if it's just cost-saving machines are not a big risk in itself. That doesn't look like this. Thank you.
Thanks. Do you want to take a few? If you take 2 or 3, Ollie, and then I'll just try and answer them all together.
Yeah, are there any other? Let me check just how we have it virtually as well for the moment. No, I have maybe just waiting for other questions, maybe myself, just more like a comment and a question, but on this concentration issue that you mentioned, which is hugely important, of course, and we are here in EBA obviously looking for very carefully the third-party service providers, for example. So this is certainly an issue which is already, but once again, something which is already there. But do you think that these AI developments could be exacerbating these concentration problems, and what could be done for that? Yeah. Yeah. Hold on. We need to get the microphone. Do you have? Sorry. Yeah. Is it Lars? Yeah. Please go ahead.
Just one question from my side, because I think, Stephen, you said on the one side that as the regulatory authorities, the supervisors are basically going to lose the battle regardless what we do in terms of being up to scratch. But then you also said that we had to kind of invest heavily in trying to kind of catch up in terms of this gap. So one thing is the use of public money, and to my experience, is always about getting the smartest people in the room, which will tend to gravitate for the higher salaries in terms of this, which will be very difficult to compete with in the competent authorities. Is it not more fair to say that the supervisors, the competent authorities, should more use off-the-shelf product once they come out into the market? Or what would you specifically tell us to kind of say that on the regulatory side, supervisory side, what should we invest in? What should be the basis of what we're looking for?
Okay, should I take these now? That's fine. That's great. These are wonderful questions, comments. So let me start with the one about cost saving. I think that a lot of it I view in the same way that I view Excel. Okay, so I say, well, this is giving us the capacity to do things that we were not able to do as quickly or as cheaply as before. And in the same way as Excel, it requires care in use. So I think that the answer to the first question is that it is largely about cost saving, but it's also about increased access and possibly increased sort of scope of service. But it has competition issues that are very much related to your point, Ollie, which is that that there are. I think that since technology is often about fixed costs. Fixed costs we know generate, I think of it as a form of increasing returns to scale, right? Because the average cost falls. In fact, it asymptotically to zero if all you have are fixed costs or epsilon marginal costs. It'll then fall to the marginal cost. But so these things are, unless these things fall in price of development and training and construct development, including construction and programming and training and keeping them up. Unless that happens, then we have to deal with the concentration. We have to deal with the concentration problem. And there, I would say that, as you point out, we are already dealing with the concentration problem. We're dealing with the concentration problem. I mean, the one that people, I think the one that my guess is that you're focusing on a number of them. Among them is cloud service provision, for instance. There are only a handful of cloud service providers in the world, because again, that's a hugely capital intensive, high fixed cost business. But the other one, the one that I would have, if you'd asked me, my number one concentration problem is that we're all using Microsoft products. In fact, you've insisted in the official sector in moving to Teams, which I happen to hate, but for a lot of other reasons, but because I don't like the functionality of it. But but everybody's moved to Teams. Well, did nobody notice CrowdStrike? CrowdStrike was a third-party service provider that brought down all of the Windows machines simultaneously with a mistaken update that was running the airlines. This is talk about a problem. So yeah, so we have that problem. Now, on this issue of what it is that the public sector should be doing, that the authorities should be doing. So first of all, the problems that you raised are again not new. This problem with the fact that that the public sector, I think that the public sector has always had a problem attracting a certain kind of talent, and so as a consequence attracts people with my hope is that you can still attract very high quality people with a combination of interesting work that's different and a working environment that offers a different kind of balance and a different style of work. And so I think that you can attract people. What I'm arguing for here is, in fact, the need to invest in people like computer scientists and people who understand how this technology works and who can develop technologies for supervisors that may involve fine-tuning and training existing general purpose AIs rather than generating your own. But even so, do you have currently the ability to take the current generation of llama, which is available, and train it to do supervisory activities? that would be a very simple thing to do. But you'd also need data, I think, you'd need sufficient data. Some of you know that there are battles going on right now inside of the EU over data access. Not battles, because there aren't a lot of disagreements. I mean, there's an attempt to find solutions, I think, that are legally acceptable to everyone on data sharing. But you'll also need the data. So I think that it's about getting human skills, which we've always had a problem with, but I think in the end, it's not terrible. I mean, I look at the fact that I have a son who's a computer scientist and an academic, and chose not to work for a financial firm at some point. I can tell you that his salary is probably 1/10 or less of what it would be otherwise. But that's perfectly fine with him. Maybe it's because he grew up with a bunch of academics around him and he thinks that's what you should do. I'm not sure, but I think you can find people. So just on those things, yes, it's cost saving. Yes, we have a problem with concentration already. But I think that we can at least be working to solve them. And the first thing to realize is that we have to solve the problems. Thank you.
Thank you very much. So I suggest we give our applause to Steve for this excellent